Namaskar, this is Professor Aman Agarwal from Indian Institute of Finance, and I'm happy to welcome you to the international conference we are hosting today, 12th September, as a Finance India International Research Conference, September 2020. It's a monthly series which we have started in the last 3 months. And I hope you can see we have these host of prominent experts and speakers who are going to be addressing conference, apart from a large number of authors who will be presenting their papers. Before we begin, I would like to point out a few disclaimers. One of the disclaimers being that we are observing all norms as advised by Ministry of Affairs to conduct online webinars and conferences. And as I video of everybody, I already made the main speaker, the guest honor speaker, the honorary speaker, opening welcome speaker, and some others as well. The presenters, I will make them co-hosts so that you could see their screen at any given point in time. Once comes up, you all for years like this, you can see us here. Today going to be addressed by Honorable Chairman and Editor of Chief Professor Dr. J. Agarwal, who is Distinguished Professor of Finance and the Editor of Chief of Finance India. Then we will have the Guest of Honor address by Surendra Kalia, who is the Managing Director and co-founder, has been from 1996 to 2014 of Standard & Poor's Asia, South Asia, ASEAN and South Asia, and member of the Board of Governors of the United World Colleges of Southeast Asia, and also an honorable member of the International Advice Council of the Indian Institute of Finance. Followed by, we will have the plenary keynote address by Professor Jackie So, who is currently the Professor of Finance and Vice President of Macau University of Science and Technology, and a Dean of the School of Business at the MUST, which is the Macau University of Science and Technology, based out of Macau, China. He is also an honorable editorial board member of the Journal Finance India. Followed by, we will have a referee's address, just to name them to begin with, and after which we will begin forward. Professor Dr. Parminder Kaur, who is from Punjab University Business School, member of the editorial board. Dr. S.P. Sharma, who is Chief Economist and Director of Research at the PhD Chamber of Commerce and Industry, one of the oldest chambers of commerce and industry in the country. Then we are followed by Professor Dr. Jaspal Singh, who is a professor at the Guru Nanak Dev University, Amritsar in India. Then Mr. Manoj Agarwal, who is a group editor for Banking Frontiers, followed by Dr. Sadr Abdul Rashid, who is Head Research Management at Al Ghor Group of UAE and has been with various organizations like Bahrain in Saudi Arabia, and has been a former alumni of the Institute from the batch of 2003-2005. At the end, we will have the valedictory session, which will be addressed by guest of honor as Mola Lil, who is director of the Oroville University of Oroville in Romania. Followed by the keynote address by Professor Dr. Kishore Kulkarni, who is Distinguished Professor of Economics at Metropolitan State University of Denver in United States of America, and the vote of thanks. In between, we will have 2 hours of paper presentations before the referees give an address. I would now, before I just go to the speakers, I would like to briefly introduce our opening speaker, and then I would like us to go to the opening address, followed by the guest of honor address, and our the keynote speaker address by Jackie So. So I'll just take a second to just introduce Professor Agarwal briefly, and then we will move on. I will quickly run through in about 2 minutes time and briefly introduce our Honorable Chairman and the opening speaker today. And Professor Agarwal has his PhD from the Delhi School of Economics and has his honorary PhD from Tashkent Finance Institute, honorary doctorate causa, which is DLEAD from the St. Isvan University in Hungary. Professor Agarwal is a leading economist, a chief editor of Finance India, and a leading economist and financial expert. In the past, he taught at Shri Ram College of Commerce, IIT Delhi, Ahmedabad University, Claiborne State University, and these are the universities where he has addressed like London Business School, the Harvard University, and others. He has written over 14 books, edited about 130 volumes of Finance India, about 30,000 pages, and has about 50 research papers so far, and many of his works have been quoted worldwide within the country. He has lectured in over 500 MDPs and has 10,000 senior executives and over 600 radio talks and TV talks, and has been a keynote speaker at over 1,000 seminar conferences worldwide and addressed at various forums in over 50 countries. His research and writing, speeches, talk, and interviews of All India Radio and TV have had an important bearing on the government policy. Some of them have the budget time change, also the Rozgar exchange, which has been set up, which is based on his work on the National Labor Exchange. The cryptocurrency, the central bank digital currency, which is in progress in terms of wanting to be created by central bank, is also something which he has worked upon. And in any case, the old budget timings from evening to forenoon in India and the KYC norms were accepted worldwide have been based on his work, where World and IMF took joint decisions to create, apart from various others. He has students for senior positions of the Government of India, including cabinet ministers, chief justices of various high courts and supreme courts, and including international agencies like the World Bank and the IMF. His main contribution has been, one of the significant contributions has been to promote the field of finance in the last over 3.5 decades through education and research. One of his most important contributions is to found the Indian Institute of Finance in 1987 without government aid. The institute has become a center of excellence and a base of scholarship in the last 33 years. IF Library has over 58,000 volumes of book and over 1,000 journals coming to it. The financial economics, which was relatively unknown, got a boost in attaining as place prominence, shifting from focus from economics, from welfare oriented and state subsidy, high taxes, control of financial economics, market orientation, and wealth generation. His another contribution is to start and develop the quarterly journal of finance called Finance India at the international level to promote research in finance. The journal started in 1987 is considered to be a leading journal, indexed at the third level by BNE Index of American Statistical Association, and also by the SJIF Impact Factor, which is out of 21,000 plus journals worldwide. Each journal is of 400 pages and has over 85 experts from all over the world, including 6 Nobel laureates. Dr. Agarwal is an original thinker and has a practical biasness. Professor Agarwal's research indicates that theories of techniques of financial economics based on postulates of single objectives give erroneous and irrational results and have become outdated in the present era. Keeping his view, he has developed several new models and theories in the perspective of theories of finance. Some of the work like goal programming model, stochastic goal programming model, capital budgeting decisions, lexicographical work, fuzzy goal programming model, goal programming model in working capital management, labor stock exchanges, as I told you about, the cryptocurrency, the central bank digital currency, which is being proposed, is on M3, M5 being developed as a monetary policy, budget time change, Kisan credit card, various others go to it, including the KYC norms internationally accepted. He has won a large number of citations and awards and quoted widely in the national dailies. He is on the editorial board of various journals. I will now go to Professor Agarwal. I would request him to kindly unmute himself and kindly give his opening welcome address, which will be followed by Suri's guest of address. Professor Agarwal, if you kindly unmute yourself and begin your opening welcome address. Professor Agarwal, please go ahead. Professor Agarwal, please go ahead.
Yes. Thank you, Aman. It's a matter of pleasure for me as the founder chairman of Indian Institute of Finance and also as the founder editor-in-chief of Finance India, the Quarterly Journal of Finance, to welcome the distinguished panel speakers, the guest, honorable guest, and also the keynote speaker. I draw a lot of pleasure welcoming Mr. Surendra Katpalia as a guest of honor. Then also Professor Dr. Jackie Chahu, Professor Dr. Paramjit Kaur from Punjab University, Chandigarh, Dr. S.P. Sharma, a well-known expert in the field and chief economist and director of research at PhD Chamber of Commerce and Industry in New Delhi. Professor Dr. Jaspal Singh, a very well-known professor of Guru Nanak Dev University. Mr. Manoj Agarwal, who is editor of Banking Frontier. Mr. Dr. Sadar Abdul Rashid, and also to have with us to deliver the valedictory address as guest of honor, Professor Dr. Lily from Romania and Professor Dr. Kishore G. Kulkarni from United States of America, Professor Dr. Yamini Agarwal, to finally propose a vote of thanks. I'm at the same time glad to welcome as many as 19 authors of various publishers, research papers which have been accepted for presentation in this conference. I'm glad to welcome, for instance, Dr. M. Sharmeen Farooq from Ithiraj College for Women, Chennai, Dr. Mahana Krishna Ireniki from Education Foundation, KL University, Andhra Pradesh, Dr. Biri Suresh from Christ Deemed University, Bangalore, Dr. T. Ravi Kumar from Christ Deemed University, Bangalore, Mr. Rajesh R. Deemed to be from Christ Deemed to be University, Bangalore, Dr. Kuljit G. Kehlan, Guru Nanak Institute of Management Studies, Mumbai, Maharashtra, Dr. Kamini Khanna, Guru Nanak Institute of Management Studies, Mumbai, Dr. R. Anantha Lakshmi, Sona College of Arts and Science, Salem, Tamil Nadu, Mrs. G. Madhumati, Sona College of Arts and Science, Salem, Tamil Nadu, Dr. S. Durga, Koneri Lakshmana Education Foundation, KL University, Andhra, Dr. P. Venkateshwar Rao, Koneru Lakshman Education Foundation, KL University, Andhra Pradesh, Dr. Lakshmi Rawat, Mala Reddy University, Hyderabad, Telangana, Ms. Sukanya R., NMKRV College for Women, Bangalore, Karnataka, Dr. Suresh G., Christ Deemed to be University, Bangalore, Ms. D. Umarani, Koneru Lakshmaya Education Foundation, KL University, Dr. N. Subramaniam from Lakshmaya Education Foundation, KL University, Andhra, Dr. Chintale Balaji, Education Foundation, KL University, Andhra Pradesh, Mr. Raj Kumar, Roman Sana Singh, Assam University, Kocha, Assam, Dr. A.S. Yarso, Assam University, Kocha. I'm really glad to welcome the distinguished panel of experts and also the panel, the referees, and also about 19 authors who have submitted and whose papers have been accepted for presentation in this conference. I would like to compliment Professor Aman Agarwal for organizing this conference, for giving an opportunity to young, talented authors and researchers. They are real research scholars who are contributing towards research in the country. Friends, I would like to share with you at this stage, 32 years ago when the Finance India was started and the Indian Institute was started also in 1987, I think we have come a long way. The first issue was about 128 pages, and today it is about 400-page quarterly journal. But at the same time, right from beginning till today, we have been maintaining 8 research papers, 8 abstracts of doctoral dissertations, so that researchers who have produced their PhD in different universities, their abstract of doctoral dissertation should be presented to the society, which may be useful for policy makers, the bankers and the government, as well as the academicians. Then we publish about 8 book reviews, an extensive bibliography running into 20 to 25 pages on one subject, then contents of about 100 periodicals. It was conceived with a view to help researchers, because in 1987 and even after that, it has been very difficult for most universities in the country or colleges in the country to subscribe to costly journals. But the researchers can find very conveniently the contents of about 100 current periodicals in this journal. Then we publish also annotated listing about 8. In other words, by now we have published more than 1,000 articles, more than 1,000 abstracts of doctoral dissertations, more than 130 bibliographies on different subjects. It becomes compendium of research in one in Finance India. Contents, of course, of articles. Then we publish about 8 book reviews, which means about 1,000 authors' books have been highlighted in the Finance India. The idea was, and then we publish about 50-page financial statistics on Indian economy and the world economy to facilitate further research in this area. And the statistics is right from the beginning, 1950-51. Now, that is the concept was so as to provide a literature to researchers who can really help contribute towards research. The idea was to give them and promote them. And we are glad that we have been able to promote research in the country by highlighting this. I remember when I was a young man, as a researcher, I found it very difficult where to publish my research paper. That was one of the most difficult situations. The cost of sending an article abroad was about $20 to $25 as a submission fee as far back in 70s. Then at the same time, you were supposed to get it typed, sent 2 papers, then send it by post, which would take about a month to reach the editor. They will take about 1 year or 2 years, maybe sometimes 3 years to give their editorial decision, and 80 to 90% of the research papers were generally considered to be rejected. I thought it is really a waste. It is a crime against researchers in this country, where dollar was not so easily available, that we should start a journal. I was discouraged. My senior colleagues, my professors, my friends, and everybody, that it is very difficult to run a journal. First issue, 128 pages. Today it is 400 pages. I am very thankful to various research scholars, more than 1,000 of them, who have obliged us and patronized us by sending their articles. And we have also been ensured that seniority is maintained. The articles are published, they are reviewed, they are referred to various people, and dispassionately and objectively, the articles are accepted or sent back for submission. Rarely we reject an article. We send them for submission with opinions, and the idea is to encourage them to upgrade them, revise them, and send it back to us. And we have no publication fee. We don't charge, like most journals charge publication fees, we don't charge any fee at all. Our cost of sending it to 2 referees, processing the article, etc., turns out to be over 2,000 rupees, 2,000 per article. That's why we have to partially ask the author to send us a submission fee so as to cover a part of the expenses we incur in terms of processing the article for accepting. We have to send them also a copy of the journal, which also is part of the submission fee itself. Therefore, the submission fee is a small amount. The cost of the journal itself is about 800 each issue. And therefore, our objective is primarily a non-profit, research-oriented to promote research in the country. I am glad Professor Amar Agarwal is promoting research through this webinar international conferences. The benefit of those authors as well as panelists would be that it would get an exposure internationally around the world. And it would also be placed on YouTube. It would be placed, the whole thing would be placed on our website as well for posterity, and people will be able to see it at any time in the future as well. Therefore, another advantage with the people who have submitted their papers is that those who want a quick publication, because there is a time lag in terms of the articles being sent and also being reviewed and then published regularly. But here in the special issue, the article is published as quickly as possible against a small token fee. Friends, I am glad you are contributing towards research. That is what NEP, National Education Policy, also wants to promote, which has just been released. The Honorable Prime Minister is interested to promote research. The Honorable Education Minister is also interested to promote research in the country. And therefore, I feel that we are doing a bit of our own in terms of promoting research in the country and motivating and the scholars to not only present their papers and also to publish their papers as quickly as possible. I wish all the paper presenters a great day. I wish them a great future in life. I wish also maybe a bit of tall order, maybe one day one of you emerges to be competing for awards internationally, including a Nobel Prize, if you continue to devote and dedicate yourself to research. And why should then such prizes or Nobel Prize not come to India and only goes to European countries and America? I wish you all a great luck. Once again, I am very pleased to welcome all the panelists, the guest of honor, the keynote speaker, the expert speaking elite valedictory address, referees, and also the scholars who are going to make this conference a grand success. Thank you, Professor Aman Agarwal, giving me an opportunity to share my views with the participants of this conference.
Thank you, Professor Agarwal, for that address. Thank you for bringing about the way we go dealing with review process. I'll inform briefly. I'll introduce a storyboard. Go on, and before we go introduce story, I thought to give these basic statistics. Firstly, we are going live on Facebook and also be there on YouTube channel level for people to refer and see the works which are presented. But just to give you a bit of conference, this conference itself, we received about the papers. 13 of papers were to be positive or positive resolution based on the Tier 1 review, which is done by a full professor of the institute with a plagiarism of 5% or less. 14 papers were to be negative and were sent back or rejected. 2 papers were due to violation of ethical code of conduct, which clearly mentioned on our website. 1 paper was written by the author prior to the entire review beginning. The 3 papers were scheduled for the other conference because they could not complete their formalities which are required. The rejection rate for the particular conference about 6-7%, varying between 50 to 70% of various conferences we have held in the past 3 months. 10 papers are scheduled. 10 papers are scheduled for this particular conference, which is being held today. And as Professor Agarwal said, we do not charge any publication fee. There is a submission fee, and as he was saying, we have about 6 professors who actually review a paper in regular course, and as a result, we have roughly average last averaging fee. When most of my frees are doing free of cost, even the cost reviewing itself comes to 18,642 rupees per paper. I'd like to briefly introduce our guest of honor speaker today, Surendra Kalia, who is currently chairman of an independent organization, Singapore National Chartered Accountant. Suri is dynamic senior executive with over 30 years of experience in Singapore, across Asia, and India executive standard in those, and an investment banker with HSBC in London and Dubai. As principal Ernst in Singapore. He is also board affiliate member of board of governors of the United World of Colleges of Southeast Asia. It's audit and governance committee since October 2012. Independent director of the Silent Foundation Singapore since December 2014, chairman of the audit committee there as well. Independent director of the EFA Real Economy Trust since March 2015, chairman of audit and committee. Independent director of the IFC Rajan Menon Foundation since April 2015. Independent director of Asian Banks International Limited since October 2019, member of the committee there as well. Member of the International Advisory Council of the Indian Institute of Finance and participates in other partnership activities of the Institute and gives us support whenever we have asked him for any help, even while he was with Standard & Poor's. Following his retirement from Standard & Poor's at the end of 2014, which was his big, which he created back in 1996 as a co-founder of this office in Asia, looking after ASEAN and Asia, Surendra stepped down from the executive committee of the Investment Management Institution of Singapore, IMAS. Surendra was previously member of the advisory board of Corporate Governance and Financial Reporting Center at the NUS, National University of Singapore, and sat on the board of Standard & Poor Company Singapore, Hong Kong, Malaysia. The work snapshot, in any case, you can briefly get on to what it is, but he has been a person who has chaired the leadership structure with wide kind of advisory structures, and I have had benefit of having a friend of mine for almost now 20 years, meeting him initially at the All Asian Bank meetings, where he would take me to his main table, and I would have the pleasure of sitting with some of the topmost CEOs and MDs of the world who's who organizations of the MNCs around the world because of his consideration, his nicety, and his friendship. In any case, he had his education at the UK Chartered Accountant, CEO of the Institute of Chartered Accountants in Singapore. He is also a master's degree in management from Ceylon, fellow from the London Business School, where Professor Agarwal has taught in the mid-1980s, and bachelor's in commerce from Sid College in Mumbai. I'll now straight go to Suri. You can kindly mute yourself, Suri, and begin your presentation. Please let me know if you're able to, and I'll inform him.
Well, first of all, good afternoon, everybody. Thank you, Aman, for your very kind introduction. It's always a pleasure to be of service to the Indian Institute of Finance. You all are doing a terrific job with the education and uplift of Indians. I have been very passionate about education, particularly as it's the biggest social leveler. And I think that all of you do a terrific job in helping uplift Indians and bring them out of that trap that they can otherwise find themselves, and education plays a very big role in that. Professor Agarwal, Professor J.D. Agarwal, congratulations to you. 33 years, huge achievements. Busy even on Saturday afternoons, organizing events and speaking at events, and which are all happening under your leadership. So congratulations. Distinguished guests, ladies and gentlemen, what I am going to do is speak for the next 10 minutes about global finance, because I'm based in Singapore, and I hope that the context that I set may be helpful. So I've just shared my screen. I hope you can all see that. Aman, you can give me a thumbs up if you can see it. Great. So I'm going to talk a little bit about what is happening throughout 2020, because it's quite a year this year in terms of the COVID crisis. We do have a presidential election coming up, but we have what you would call a once in a century black swan event, which has come as a huge shock to everyone. But we should be thankful for some things too, and I will talk a little bit about that. Now, when we talk about finance, the real role of finance is that it is the engine for the economy, because it provides juice for the economy, it provides oil to support the engine. And we all know that it supports economic activity as it helps businesses, individuals, governments with expenditure and also investments for projects. At the same time, it provides people opportunities to invest their savings, and those savings can be tapped onto, for financing projects. Yeah. Now, there has been a lot of debate, and when I talk about Wall Street and Main Street, I hope you will excuse me for bringing US terms there, because I guess in the Indian terms, it would be Dalal Street of Mumbai and a Main Street equivalent, yeah. But the question we always ask ourselves, should there be a connect, or should we expect a disconnect between Wall Street and Main Street? Now, when I joined Standard & Poor's in 1996, one of my early lessons, and I remember asking the head of the Asia Pacific Financial Institutions Ratings Group a couple of things, and he taught me some very interesting fundamentals which I thought might be useful today. The health of a country is only as good as its economy. The health of an economy is only as good as its banking system, okay? Because if you have a sound, solid, robust banking system that is fully functioning, that usually is an indication that that usually leads to a healthy economy. Now, the health of the banking system is only as good as the corporates it lends to. You could take that further, that the health of the corporates is only as good as the businesses that they run, and so on. So the question I would hope that someone might try and seek to answer at some stage is, so the health of the financial markets, yeah, how good are they and what drives them? When we look at economic health in financial markets, there is a lot of literature that supports that the two have been intertwined since the 1929 Great Depression, and you can see a lot of linkages and correlations. We know that Wall Street has been buoyant despite the huge surge in unemployment. We've had unemployment close to 20 million people, or slightly about 20 million people at the peak in the US this year. I was reading in Global Finance about the bankruptcies that are taking place throughout. It's not just a US phenomenon, it's across Europe, the UK, and so on. Some of the names that we would call as, flagship companies and so on, they're just being wiped out. And we are seeing an economic disruption of the type that we've never seen before. So why do we have a situation where the economics looks so ugly, but it would appear that the stock market is in the pink of health? So one view is that stocks are not a reliable gauge of economic health. And you could argue that yes, stocks are a forward and a leading indicator and may not be an indication of things as they are now. But let's explore a little bit further on why this divergence between Wall Street and Main Street as we see it now. So what are the factors that are driving this? So we've got interest rates in the US, which are at record lows. They're at 0.25 basis points. That's the Fed's Fed rate. You've got a lot of money being pumped into the economy, and we're talking of trillions of dollars being pumped into the economy. You've got the Fed buying, for the first time ever, corporate bonds and providing liquidity in the marketplace. But there are some new things, that a new phenomenon that's also happening on Wall Street, and what's called Robinhood investors. I don't know how many of you are familiar by this fintech company called Robinhood, which charges 0 brokerage fees. But it's got primarily millennials, and millennials sitting at home have been very active investing in the markets. Now, I heard these 3 terms, and you can see I'm 64, but I'm still learning millennial terms. So there are 3 factors that are driving these Robinhood investors. So stock prices of the tech companies. So if you look at Tesla, at the beginning of the year, it was $300. And if you look at it where it is now, in 9 months' time, it's 8 times that price. There has been a stock split at the beginning of this month, but if you take it, inclusive of that split, you're talking of a price that has gone up 8 times. So what you see happening is the fear of missing out. So people don't want to miss out, and are they ignoring fundamentals? The second is TINA, which is there is no alternative. That means everybody is just looking all around the world that the only market that counts is the US stock market. So they are investing there because they've got nowhere else to invest. And then the third one, which probably comes from James Bond, is you only live once. So that's really what some of the themes that are being talked about as to why US equity markets are so buoyant. And that might be a casual way of looking at it, because I think the reasons are deeper, and we'll come to that in a few slides. One of the things that I spoke about even at the last IIF conference that I spoke at a couple of months back was that right through this pandemic, if something has functioned the way it was expected, as we've seen financial markets globally being fully functional right throughout the pandemic. Can you imagine what would have the chaos that would have happened had the banking system shut down, or stock markets closed down, or capital markets shut down? Those consequences could have been even worse. Now, few things. What you're seeing on Wall Street is a handful of tech stocks. You look at where Apple is today and where ExxonMobil is. Apple's market capitalization is roughly 12 times that, if I remember correctly, of ExxonMobil. And ExxonMobil, not too long back, was one of the largest companies in the world. Why are these tech stocks growing up? I'll deal with it in the next slide. The other thing that is happening is it's US stock markets that have been buoyant. The rest of the world has not really caught up. I know in India there have been patches, but the rest of the world hasn't quite seen the same bubble effect. And I'm going to call it a bubble because whenever it defies fundamentals, I think that's the right term to call it. So it's a US phenomenon as opposed to the rest of the world phenomenon. And you're seeing that more in equities rather than bonds. Bonds have also done well, but bond prices have generally been in check. And the last thing is the US dollar, despite everybody expecting it to fall, continues to be the currency of choice, the currency of reserve for the rest of the world, and continues to be strong despite a deteriorating economy. Now, when I said that I would look at the tech stocks versus the rest, and this is, who are the winners and who are the losers as we see them now, okay? So on the left-hand side of my screen, and I presume it's the left-hand side of your screen as well, I've got what I think are some of the winners based on what I've seen. So, you know, Amazon, Netflix, you've got gaming companies like Sea out of Singapore, Facebook, Google, new tech companies, renewables, and I would put Tesla here because Tesla really is coming across as an energy-saving renewable company in terms of clean energy and so on. In network connectivity, I would talk about Zoom. When I talked about social media, I forgot talking about TikTok, which I think you're missing in India right now, right? I'm not making any judgments. It's just meant to lighten a Saturday afternoon. So treat it as a joke in that context. The other thing that we would expect is, should online education be a winner of this? And people have been asking, do I need to pay Harvard fees of 60,000 US dollars a year if all I'm going to do is see Harvard online? Because, you know, a Netflix subscription is a lot cheaper. I'm not saying Harvard is a great place and I have the greatest respect for it, but that kind of online learning model, if that is going to be a long-term model, is not sustainable in my view. Oddly enough, luxury goods have continued to be a winner because, you know, people are not going out on travel and they need some retail therapy. And so the luxury goods have been doing quite well. So Louis Vuitton bags have still been flying off shelves. Now, on the other side, who are the losers? So public transportation, you know, we've seen the airline companies all across the world being crippled. Hotels, we've seen Marriott, Hilton, and the likes, some of them near bankruptcy. Hospitality would be clubs and cinemas and entertainment and things like that. Anything which is not OTT. Brick and mortar retail. So names like Brook Brothers, which have been legends and have been around for a long time, are all suffering. You know, J.C. Penney. Commercial real estate. Do we need commercial real estate if we're going to be working from home and people are going to be shopping online? The big question people are asking is, if we have a vaccine that comes out sometime next year, is it going to be back business as usual, or we are going to find some people saying, I'm quite happy working from home, some people saying, no, I miss the office. The jury is out there. I don't have an answer. I'm retired, so I enjoy working from home. Okay. I think old tech has not won the same way. So if you see people like Adobe, Oracle, and so on, they have not seen the same spurt in activity as what you've seen with the new tech. Clearly, the energy companies are down because people are not traveling, planes are not flying, and so you see depressed oil prices. And lastly, I brought that because, again, it's relevant. The universities in the US, UK, Australia, where are they going to continue to get their students if this pandemic continues? Is this a short-term bump or a longer-term bump? Lots of questions from this. I'm not trying to provide you answers. I'm trying to stimulate conversations this afternoon. And even beyond that, I think Professor J.D. Agarwal, you've got terrific people who write great articles for you. I hope that they will pick up on some of these themes and address them. So I'm going to close here and say thank you very much. Have a lovely afternoon, talking about some very interesting things happening in the world today of finance. And with that, I'll say thank you and over to you, Aman.
Thank you, Sue, for that introduction and actually giving the energy to the mind, a thought for all researchers who are here today. We'll be going to the keynote now, and we will be going to Jackie. But before we go to Jackie, Suri, do stay back for a few minutes before the inauguration. After that, maybe you want to leave, you're when to leave. We'll go to Jackie. Before we go to Jackie, I want to introduce Jackie as well, although he's been an old friend of mine, known him for decades now. But Jackie is now a very big man. He is currently chair, professor, and newly appointed vice president, founding dean of the School of Business at Macquarie University of Science and Technology. I have had the pleasure of visiting where he was dean before, the University of Macau, and of the school, and then he hosted a lunch in Manor as well, and saw the city of Macau at his place a couple of years back, me and my wife. Over the course of 20 years since Macau University of Science and Technology founded, it is upholding the education philosophy, and now he's both academic and an administrative role because he's vice president, which he was from September 2003 to oversee national cross-country event prosecution. And I know he was much tied up the AACSB accreditation review, which was going forth before him. But then, you know, I fortunately have this still love and affect with my friend, so he could not know, and I could convince him to give us an hour to be here with us. And Jackie has received a PhD from Ohio State University, one of the very prestigious universities in the United States. A government university, one of the top universities in government universities. Been Dean of the Banking District Professor of International Finance of the ASAS School of Business AM University. When I met in Syrup almost about 25 years back, as well as the Executive Director of the Academy of Entrepreneurial Finance. This is a conference which they were hosting, and I was invited to give a keynote at this in Syracuse University with another dear friend of mine who's been on the editorial board called Alan. He was a professor of finance of economic finance department of Southern Illinois University, and for more than 20 years served as the chairman for almost 10 years. He's also been president of the faculty at the university. Professor has vast experience as a consultant of many corporates and law firms. He is visiting scholar and consultant of Federal Reserve of Chicago, Philadelphia Stock Exchange, Federal Reserve Bank of St. Louis, Small Business Administration, Washington, D.C., amongst others. Further, he is also a total board member of Global Finance Journal, Journal of International Business, Journal of Entrepreneurial Finance, Academy of Entrepreneurial Finance, Finance India, and as well, and a book editor of Northern American Journal of Economics and Finance. Professor So is a research interest of international finance, banking, corporate finance, and risk management. His recent more than $1 million grant to support his research, teaching, and service activity. In 2010, he was invited to be visiting scholar of the International Monetary Fund of Asia and Pacific Department, and received an Education Leadership Award for the Asia's Best B School Award 2014, held in Singapore, making the first person from Macau to receive this award. Later in 2016, Professor So was invited to the Research Fellow of the Hong Kong Institute of Monetary Research. He was the Dean of the BNU Professor of the Faculty of Business Administration at the University of Macau, and the co-director of Asia Pacific Academy of Economics and Management from 2000 to 2018. We did try to develop academic collaboration with the university, but I think now he has more power with him, where we can make, after the ACCB goes off, then maybe inspiration, we can look at some kind of an academic collaboration between the Institute of Finance and MAS going forward. The university believes that this is the international outlook, broad activity, impact, and rich experience in teaching, research, administrative management. Professor will bring about new impetus for University of Science and Technology, helping the university develop high-quality education, enable international exchange programs, and unite strength and collaborations. I will now go to his presentation. I will just start your presentation, Jackie, and then maybe you can begin.
Okay. I think I need to. Do I need to turn off my computer?
Turn off your computer.
But then, how can I do my PowerPoint presentation? Well,
I will start presenting, Jackie.
Okay, let me. Are you there? Can you see me?
I can hear you. Let me just start your presentation. Just kidding.
Okay, so but how about my presentation? Can I just use my kind of handout in front of me rather than the PowerPoint that I showed you?
You can use your computer, but just log off from the Zoom.
Okay, so log off from this iPhone, right? So let me go back to my computer.
No, from the computer. Keep the icon on, please.
Okay,
your
let me see. But
presentation is now.
The echo sound. Okay, give me a couple minutes. I need to log back into the meeting.
No, not echoing. And begin, Jackie.
Huh? So, okay, I
You
see.
can begin
I
the
see.
presentation and it on.
So first of all, again, thanks all for the introduction and the invitation. This is my second time to join this group of outstanding scholars and researchers. So thanks a lot for that opportunity and introduction. Of course, I got to thank Professor J.D. Agrawal. I think he's so outstanding. His leadership for the Indian Institute of Finance actually is very, very amazing and appreciated. And of course, the research outlet for the researchers, especially the younger researcher, I think is very critical and important. I myself are very interested in the concept about an M4 and M5 for the cryptocurrency. I believe that about 3 or 4 years ago, I did a paper at the Hong Kong University. Actually, I tried to get a model for cryptocurrency because we have all this empirical evidence and the trading volumes getting bigger and bigger. However, I don't think we have a good theory to explain this kind of digital currency. And then we use this term currency. Maybe that's what it bothered me, whether using M4 and M5 is consistent with what we used before, because those currency, cryptocurrency, they're not really currency. They are more or less asset, financial assets. So we need more research to really get to this important issue. So again, congratulations to Professor J.D. Agrawal for this successful Indian Institute of Finance. So the topic I'm going to share with you guys actually is kind of closely related to our speaker, Professor Kafapalia. He just mentioned about back swap. So, you know, you look at my topic, then you see that my topic is value at risk and stress test, the impact of fat tail risk. Fat tail risk actually is the back swap effect that have very small probability, but when it happens, the loss, the damages can be very big. Now, lately, this coronavirus, again, is similar to that situation. The economic impact, the losses that it creates to all this hotel, hospitality, airline, again, mostly is also fat tail. So what we're trying to do is get a model. And then, of course, in this paper, I kind of apply it to the bank capital in China, in Hong Kong, I think maybe even in some European countries. But there are a lot of technical issues. I may not have time to go through all of them. So what I want to share with you is to tell you that using the normal distribution assumption to measure all the value at risk, I think is not appropriate, is totally underestimated. So in my PowerPoint, I will show you some evidence. Of course, there's some models, some theory, some technical statistical issue. Again, I may have to skip it because of time. Again, I believe that this same approach can be applied to the current kind of virus situation. Then my objective of this paper, again, as I mentioned, is to, actually, Bernanke, the former Federal Research Chair, mentioned this concept before that, you know, all these stress tests, we could measure all of them in all kind of risk, but we should be interested mostly on the tail risk that, that I'm going to talk about. Again, in Bernanke in 2013, in his speech, he suggests to use a unified approach. And there are many other scholars, they also use this approach. So our objective, as I mentioned, is to show you that if we use what I call stable Pearson distribution, it could capture the tail risk. And that is better than the normal distribution because the tail risk is fatter than the Gaussian model. That means the probability of big loss actually is much larger than those predicted by normal distribution. We also propose a new measure in terms of what we call expected maximum losses. So rather than using probability of losing how much money, we actually convert them into dollar amount. So to see how much bank would suffer under all this 2008 financial crisis, and then before that, I think the dot-com and saving and loan crisis in the US. Again, I will show you some graphs that in my PowerPoint that really showed you that we have to consider maybe this distribution, the stable Pearson. So the historical crisis that I have in my PowerPoint, I know, George, would you be able to turn this PowerPoint to the second page or third page for me? Hello?
Yeah, Jack, put it on the page now.
Okay, I think if you, because my iPhone, I could only see the title page, but not the historical crisis. Or I think it's page 5. Can you turn it for me?
I'll go to historical crisis now. Page 5. Page 5 now.
Okay.
Historical.
So you already, okay, I guess there, I showed you that the losses for the S&P 500 in 1974, right, is 20-some%, and in 2002 is 22%, and I think that's the internet bubble, and then the 2008 financial crisis, the loss of S&P is more than 30%. So these are big losses because the subprime mortgage crisis, again, all of us remember. So, so we focus on these 3 crises, and then some empirical data that I'm going to show you actually found out that the differences, if you look at normal distribution in terms of their probability, and then compare with this stable Pearson probability, our estimate will be more reliable and more accurate, okay? So again, table 2, I showed you a little bit more about the saving loan crisis and the submortgage crisis in terms of when they start, when they end, and then all the bailouts the government provides. I mean, they're huge amount of money. And then of course, there are losses, okay? Output losses and financial losses. So if you look at my page 6, they showed you this kind of evidence. Now there's a diagram. Yeah, page 7. Do you have this curve, page 7, about the normal curve and the fat tail distribution? Did you see it, George? Did you show the audience this one?
The graph is your view is your view is fine. Video is turned off in your file. Just switch it off.
Okay, so I will just continue then. Anyway, so this normal curve versus the oh, I think I. No, it won't work. So I'm going to go just back to my iPhone. So hopefully you don't mind because of the technical problem. I just stick to my paper that I have in front of me. So George, you show the audience the PowerPoint, wherever you have. Okay, in this figure 1, in table page 7, I showed you a graph that you have the normal curve, and then you have the empirical data from some of those bonds returned in 2006. And then the stable distribution, which have the fat tail. If you look at the left tail, you could tell that there's some big, people call it outliers. Actually, they're not outliers. There's a lot of information there to tell us that some of the crises with very small chance with huge losses. So again, this is based on the histogram of the bond return in 2006. Then I try to enlarge the left tail, which is the losses. If you look at that, and then you find out that when you go to almost not just 1 or 2 standard deviation from the mean, if you go to more or less 4 or 5 standard deviation, you find out that, wow, there's big losses. So again, you compare the normal with the stable, the tail or the density or the probability is much higher That means the stable model is more accurate in capturing those extreme losses due to those financial crises. Then the next page, I talk about several model because we could use some kind of model, let's say based on Tversky, 1999 and 2000. So what we need is to break the normal economic condition versus the stressful or crisis period, similar to a regime shift kind of situation, but they have the model and the probability associated with them. Now the model itself, we use the capital asset pricing model in finance, and then we allow for actually time variance risk. So the beta, the systematic risk, or the systematic risk, they are time changing. So the model itself is a little bit complicated than the normal one. So it's a function in a function with the model that the parameter are changing. Okay. So on page 9, I set up that model, and then again I extend the model to probability on page 10. Okay, and then I describe to you that the stable distribution on page 11. We have 4 parameters to capture those extreme losses, which is the characteristic exponent alpha that capture the big risk, the fat tail risk, the back swarm effects. And then the skewness, which is the negative tail that I enlarged for you before, the beta. And then the scale, this is more or less a standard deviation in normal distribution, except that in normal distribution, we use standard deviation. In stable, the second moment or anything higher than second moment is not defined. So we have to use something else, which is what we call the scale parameters, okay? Again, I apply this kind of concept to the stress test because of Basel 1, 2, 3, and then now they're talking about the other measure. The vision, the value at risk is kind of questionable because they violate certain statistical properties. And then, of course, people then start to recommend conditional value at risk. And our extreme maximum losses actually is more or less like the conditional value at risk. On page 13, I showed you another graph that for those crises, and then if you look at the actual data, you look at a normal prediction and the stable prediction, our stable prediction is much more accurate in capturing those on the left tail, fat tail distribution. Then because the gauge model of Robert Engel and his student are very popular, so we introduced several models, the stable gauge, the gauge itself, then the asymmetric gauge. So I present that 3 model on page 14. And then again, we have to use a model in terms of asset pricing. So on page 15, I introduce the modified CAPM that actually allow for non-normal distribution, skewness, and then some of this time variance feature. So that is much more complicated than the simple CAPM. Now, again, there's all kinds of differences in terms of modeling. So in order to see how sensitive they are, my co-author, my PhD student, Tony, and I look at if the residual of those models are stable and non-normal, what does it mean? What is the prediction look like? And then if they're asymmetric, then what does it mean? Or what would they look like? If they're symmetric, what is the skew? If they're symmetric, then what happen? And if they're normal, then what happen? So we also talk about student T. We also talk about the generalized error distribution. So we actually compare 1, 2, 3, 4, 5, 6 models together to see which one actually have the better goodness of fit. Again, I explain more about systematic risk and how to estimate the extreme losses on page 17 and 18. Again, those are statistics. If you are interested, actually my paper is available on the Hong Kong Monetary Institute of Research. I finished this project when I was a visiting scholar there a couple of years ago. So you could go to their website to download my paper. If you cannot find it, send me an email. I would be most happy to send you my full paper. Okay. So again, on page 19, I also talk about how to estimate the extreme market losses and then how to capture it in terms of tail risk. Now, if you aggregate all this together and compare with the borrowing, which is the debt ratio that the bank may use, then we will have this aggregate TRT, which is the total tolerance amount. So if you want to have a sound banking system, if you're the Federal Reserve Bank, you want to say, hey, those too big to fail bank, if all together, I want to prevent them from failing as a regulator, how much money I need? This TRT is the amount that we try to measure. Our other innovation is trying to use an engineer called a Fourier transform, because the stable distribution do not have, I guess, closed-form density. Again, as I mentioned, their second moments or higher are not well defined. Therefore, we have to use something else. Luckily, in engineer, we have this fast Fourier transform, which is more or less like a sine cosine function that allow us to get something similar to what we call characteristic function. From there, we could get something very similar to the normal distribution density. So we kind of lay out all this methodology, how to use that method, the Fourier cosine expansion, to get the probability based on a relatively new publication. Again, I capture it with the stable distribution in page 20, on page 22, 23, and 24. Again, if you're interested, we could discuss more about the mathematics behind them. Then I would turn to, again, the page 25 and 26, how to capture those gauge and asymmetric gauge and with the extreme losses. Okay, so those are theory, the statistic. Our empirical results is based on the market index, the S&P 500 index, the bank liability and their market return. And we look at 51 financial institutions. And these are larger banks. They have usually at least market equity greater than 1 million, and then without bankruptcy before 2008. Okay, we do the estimate. Our time period is from 1987, June 30 to December 2014. We also break down into two periods, one period to estimate the parameters, and then the second period to get the prediction. For financial statement liability, we use the quarterly data from the Compustat. Okay, because of time, I'm going to just show you some very obvious empirical result. The report and all these estimates are available on page 28, 29, and 30. If you look at all these statistics, the alpha estimate show us that indeed most of the return for those banks are not normally distributed. That means they're fat tail. Some of them are skewed, some of them are symmetric. So our results show that maybe you have to be careful about estimating the bankruptcy risk of different banks. Then on page 31, we try to see if there's structural change. If something did not happen before and something suddenly happened, let's say in 2008, before the subprime mortgage crisis, how the bank return and risk look like. And then after that, what will happen? So we showed you that in fact, there's a big changes there on page 31. And then 32, we provide the estimate about the extreme losses. And then on page 30, we have the estimate for the gauge, for the asymmetric gauge and other models. Okay, the most important, I would say, simple finding is this diagram on page 35. If you look at this aggregate total risk tolerance, okay, we use one example here. I think this is some of the bank. You see a big jump before the 2008 mortgage crisis, okay? So before that, suddenly this total risk tolerance jump up a lot. That means the bank need more capital to support themselves for the storm that is coming. So our model actually have some prediction power to say, hey, you better have enough capital, because after the boom, with the bailout and with all these things, then of course the risk go down. And we support this with some empirical data. Look at Citicorp. Citicorp have the same behavior that I just mentioned, okay? Before they have a lot of problem or risk, and then later on it get better, okay? Of course, when they inject more capital and with the government bailout, they become solvent. Same evidence we found from Wells Fargo, we found from the Bank America. So our conclusion is that indeed, when we try to estimate the risk and the jump, the fat tail risk, maybe the stable distribution is one good candidate. And then our shake parameter before and after indeed support our recommendation. And this total risk tolerance funding recommend that we have to look at that the fat tail actually indicate how long those banks could survive with this kind of extreme back swarm effect, okay? For government, they have this QE1, QE2, QE3 to increase the liquidity. I think this is one alternative to save some of the too big to fail bank. But then, of course, we need to consider the costs and benefits, right? All of us know that if you give them all this bailout without any condition, it becomes free lunch, then the bank will have more risk incentive to take more risk, because tail, the taxpayer lose, gain, the bank banker or their shareholder gain. So we have to address this kind of agency problem or the more moral hazard issue in the banking industry. With that, I better stop here. And I'm sorry for the technical problem. And of course, I also have another meeting. I need to go anyway. My colleagues are waiting for me and I'm 30 minutes late. So any other question that maybe some of you want to ask me before I excuse myself?
No, we'll take questions later. So whatever question there, I'll bring it before you. And in case people like to have a copy presentation, if possible, can you email them the PDF?
Again, can you repeat it? I had trouble. There's some echoing sound there. You want
exactly.
to have
if you want a copy of your PT, can you email it to them?
you said the PPT, can you share you with the audience?
Copy of PT, email to them.
I think it's okay. I could share with them. I don't mind. Yeah, as long as they refer to our work. Yeah, it's okay. Is that your question? You want to distribute with them? I want to share with some. Perhaps you could send me a message and I could answer it, George. Yeah. Again.
Sure. I said that
okay.
if someone's copy of PPT, if we can it.
No, the line is break, so I cannot hear you. You said someone is interested in the PowerPoint, right, or something like that?
If someone's a copy PPT, can we email them? Can we
can you email them, or can I email them? Yeah, sure. I could email them. They could send me an email. I could email my PPT to them. Or if they want you to send them, you have my copy, you could email them, no problem.
That will be great. Thank you for being with us and give this.
Okay, thank you.
Aman sir, you're muted, I think.
Thank you, Sadar. And I was saying that thank you, Jackie, for being here and for giving the address. And you're welcome to go when you want. I would like to now begin with the paper presentation. Each paper gets about 10 minutes of presentation time. I will be making all the speakers the co-host as the paper comes. So the first co-host speaker is Dr. M. Sharmeen Farooq. I've already made her the co-host. She can begin her presentation in just a few seconds. Everybody else is requested to kindly keep their audios and videos off. Only the person who is speaking, who is supposed to go, is when requested. And one more rule, sir, all paper co-authors are requested to be here. So kindly ask if someone is not here to join the conference. We will be taking a photograph of every speaker speaking. So I would request if you can kindly keep your videos on while the paper is being presented. And as I said, the first paper is the FCFF Valuation in Indian FMCG Sector, Empirical Evidence on Top 10 Firms by Dr. M. Sharmeen Farooq from Itiraj College of Women, Chennai, Tamil Nadu. I give it to you, Dr. Farooq. You can begin your PPT and start your presentation now. 10 minutes for you, please.
Good afternoon, sir.
Good afternoon. Please go ahead.
Well, good afternoon, sir. Are you able to see my screen? Good afternoon. Are you able to see my screen?
Yes, I'm able to see your screen. Please go ahead.
Okay. Good afternoon to one and all present here. I'm Dr. Sharmeen Farooq, Associate Professor from the Department of Corporate Secretariat, Itiraj College of Women, Chennai, Tamil Nadu. At the outset, I would profusely like to thank the organizers of the conference for giving me this privileged platform to present my research work. Let me begin with a significance of the FMCG sector, the fourth largest sector of the Indian economy. The main segments of the sector are food and beverage, which accounts for 19%, healthcare 31%, household and personal care, which account for the remaining 50% of the sector. The reason why I chose valuation in this sector is mostly the companies have low price goods. There is a persistent demand for the goods and quick sale of goods which are mostly perishables. Brand loyalty plays a very important role in the sector. There are many main players, MNC, domestic companies. MNC companies have strong parent funding and even domestic companies have less or no debt. This slide gives you an overview of the FCFF method. Free cash flow to the firm is the total cash flows which are available to the debt and equity shareholders after making adjustment for non-cash expenses like depreciation, amortization, non-cash working capital, and capital expenditure. The rationale behind using the FCFF technique in the FMCG sector is mostly you have mature firms in this sector in a stable market. Also, they have faced strong competition, so they cannot sustain the high rates of growth for any length of period of time, and companies have less or no debt. So FCFF technique can easily be applied in a two-stage model: the explicit period of high growth of 10 years, where most of the inputs are the existing rates for the company, and a period of stable growth forever, where the growth rate is made equal to the growth rate of the economy. Coming to the next slide. This slide tells you the previous work on the field in the field of valuation. Considerable attention has been paid to accounting numbers and firm value. Ball and Brown's research shows the information content of accounting numbers. Beaver, Dukes, Patel, and Kaplan have identified proxies for accounting earnings. Finger Club Bar have showed the superiority of cash flows over earnings. Benninga and Sarik propose to use more than one valuation method because of the uncertainty that exists in firm valuation. Then Kaplan, Rubach, Fernandez, Gitman, Trahan, Graham, Harvey, and Imam have accepted DCF to be the best method. Damodaran, Kohler, and Penman support the FCFF method. Half of all the analysts have used the DCF method, and all other methods were used in complementary to the DCF method. The FCFF method, which I have used in this study, is also a part of the DCF method. Coming to the next slide. This is the objectives of my study. The first objectives is to measure the firm value of top 10 firms in the FMCG sector with the FCFF technique. Next is to evaluate the impact of 11 parameters: EBIT, interest, depreciation, capex, revenues, growth rate, debt ratio, reinvestment rate, non-cash working capital, return on capital, cost of capital on the firm value. This slide shows you the companies for which valuation has been performed. The selection of companies has been on the basis of the revenues in the FMCG sector in the year 2020. The valuation has also been done in April 2020. Financial data for the same has been collected from the annual reports of the companies. For some variables, the data was collected for 5 to 10 years, and other variables it was collected for a period of 2 years. For example, R&D expenditure, operating lease, options, it was collected for 5 to 10 years, and then EBIT, cash and marketable securities, non-cash working capital, and a whole range of variables for about 2 years. I have used the synthetic rating estimation method to determine the cost of debt. For this purpose, I have taken the rate of interest of a 10-year government bond in India in 2019, which is 7.48%. And from this, I have deducted the default spread for India based on Moody's rating, which is Baa2, 2.82%, to arrive at the risk-free rate, which is 4.66%. So to the risk-free rate, when the default spread of the company based on its bond rating is added, we arrive at the cost of debt. This is a cost of debt on before tax basis. I have also reduced the taxes to arrive at after tax cost of debt. As most of the companies in the FMCG sector are MNCs, I've used the equity risk premium as 6.51%. This is the ERP for the Asia region, updated as on 1/4/2020. The overall cost of capital calculated is with different debt components. One is with the existing debt ratio in a period of high growth, and 30% in the stable growth. And I've used the spreadsheet FCFF Ginzu 2014, developed by Professor Ashwath Damodaran, Stern School of Business, New York. The statistical techniques which I've used are t-test, Carl Pearson's coefficient of correlation, stepwise regression, and ANOVA. Coming to the results of the firm valuation, you can see from the slide, the value of operating assets of the firm is the sum total of present value of free cash flows in the high growth phase plus the present value of terminal value. From this, if we add the cash and marketable securities and non-operating assets, we arrive at the total firm value. When outstanding debt and minority interest is deducted, we get the market value of equity. When option value is further reduced from the market value of equity, we get the equity value in common stock, and this is divided by the total number of outstanding shares to get the value per share. This is the valuation for the other 5 companies. This is the percentage of components in firm value. You can see the first line is the percentage of present value of free cash flows in the high growth phase, and the second line is the present value of terminal value. You can see that the present value, terminal value, is very high, especially for some companies. It ranges from 80 to 94.5%. And I found that for these companies, the ROC was very high. Then coming to the value of operating assets, it ranges from 92 to 99%. So most of the firm value arises from the operating assets in the firm. Cash and marketable securities and non-operating assets are 5% for Amul and 7% for P&G, and for all others it is very less. Outstanding debt is 34 and 35 for Colgate and Amul. All the other firms have a very low debt ratio. Minority interest and options are a trivial portion for all the companies. Coming to this slide, which shows the highest and lowest values. The highest revenues, capex, EBIT, is for ITC. The highest non-cash working capital is for Godrej. The highest growth rate has been achieved by Hindustan Unilever Limited. The minimum EBIT is for Parle Agro, and the highest debt component is found for Amul India. Coming to the results of correlation analysis, I found that the parameter with the highest correlation as the ROC, its T statistic, was also found to be significant. Non-cash working capital revenues and EBIT follow from the return on capital. Interest expense and debt ratio have a negative relationship with firm value. So more the expense and debt ratio, the lower is the firm value. So out of the 11 parameters, ROC, non-cash working capital, revenues and EBIT have strong correlation, and depreciation and growth rate have moderate correlation. Coming to the results.
Farooq, one more minute.
Yes, sir.
Yeah, go ahead. Please go ahead.
Okay, coming to the results of regression analysis, stepwise regression was adopted to identify the significant predictors in analysis. You can see 4 regression models over here. The 4th model with ROC, revenues, reinvestment rate and negative ratio showed the highest R square. So 92.7% is the impact on firm value because of these 4 predictors. The highest R square change is for when ROC is introduced, and also the next R square change is when the revenues are introduced. And the 2 models, that is with ROC and revenues, the regression weights are found to be significant. Coming to the next slide, the results of ANOVA. You can see that all the 4 models, the values are significant, and F values are also very high. So the predictors are effective in predicting the firm value, and standardized coefficients are highest for ROC, followed by revenues. Coming to the last slide, which is the findings and implications of the study. The single and most important determinant of firm value is ROC. So ROC accelerates the growth rate, which leads to higher terminal and firm values. Now, the other parameters which follow are higher revenues, higher reinvestment rate, and a lower debt ratio. All these also contribute to higher firm values. And I found that the gap between ROC and cost of capital is very important. So higher this gap, higher the terminal value and higher the firm value. So if companies focus on increasing the ROC or reducing the cost of capital, they will be able to increase the terminal value and firm value. Then terminal value for nil debt companies has leads to higher, for nil debt companies, it results in higher terminal values. So if the companies have zero debt in the high growth phase and it is increased to 30% in the stable growth phase, the terminal values increase and also the firm value increases. But if there is not much change in the debt ratio between the 2 phases, then the value of the firm is also lower and it is split between the high growth and the stable growth phase. From the valuation of companies, top 10 companies in the FMCG sector, I found that most of the companies are well positioned, and the high firm values are a result of the high popularity of the brands, which results in higher revenues and high rates of return on capital. Firm valuation in this sector is very important because this sector is a lucrative investment for many investors. So firm valuation and finding out the intrinsic value of the share would be a technical suggestion for them to suggest whether they should, how they should make their purchase and sale decisions much better. With that, I end my presentation. I thank all of you for giving me this opportunity. Thank you, one and all.
Thank you, Dr. Farooq, for the presentation. We now go to the next paper, which is on eminence of urban cooperative banks in India by Dr. Mohan Krishna Iriki from the KL Education
sharing.
Foundation. Just a second. You'll have to stop that, please. If you can do that, please. Yeah. Yeah. Can we have Dr. Mohan Krishna kindly start his, open his video and start his presentation, please? I've already made you the co-host. Yes, you're audible. Can you please start your presentation, Mr. Mohan Krishna? Dr. Mohan Krishna Iriki is from the KL University in Andhra Pradesh, and he's going to speak about the eminence of urban cooperative banks in India. Please go ahead.
Give me a second, sir. I'll just share the screen.
Sure.
Sir, is this screen visible, sir?
Yeah, the screen is visible. The PPT is, yeah, it's fine.
Yeah, okay, yeah. Yeah. So this is the good afternoon all, and this is Dr. Mohan Krishna. And my title of the paper is Eminence of Urban Cooperative Banks in India. So the major motive of this paper is to have an analysis of the financial performance of the urban cooperative banks in India for the last 5 financial years. That is starting from 2014-15 to 18-19. And we have ensured that all the banks which have been there in the entire country have been considered for this analysis part. And it has been observed that the the urban cooperative movement has got its initiation way back in 1882, where the European countries have started this movement. So the primary motive or the functioning of the urban cooperative banks is to ensure that the savings have been pulled from the middle and low income segments, which can be channelized towards the credit disbursements of the other departments. Okay, so largely the urban cooperative banks is largely focused on the urban society, where the middle and the lower segments are being still in the clutches of the money market lenders, and also they strive hard for promoting the savings habit among the urban segments of the society. And the major objectives which I was saying earlier. So the other objectives are the identify the significance in the functions of the urban cooperative banks, and at the same time ascertain the financial status of the urban cooperative banks in India over the last 5 years, and also ascertain the factors which are impacting the overall progress of the urban cooperative banks. Okay, we have taken around 9 papers for literature review, and we have given some of them over here. Coming to the evolution of the urban cooperative banks, it has been viewed that there are various phases where the particular urban cooperative entities have been coming into picture over the period of time. Okay, starting from the let us take the evolution. So it has started its evolution in 1889 with Anonya Sahakari Mandali, which is one of the significant factors coming out of that cooperative movement. Okay, subsequently there have been various committees which have been rendered by the government of India to improve the financial performance of the urban cooperative banks. These urban cooperative banks come under the purview of the state registers of the cooperative society, and as well
Dr. Iriki, kindly keep your presentation in 10 minutes. So you have 7 more minutes to go, but kindly see that it's 10 minutes because otherwise it goes long for everybody.
Yeah. Okay, then I will directly go into the analysis.
Please kindly make it in accordance that you have 10 minutes. Yeah.
Okay then. Okay. So the urban cooperative banks come under the purview of the state registers of the cooperative societies as well as the central register of cooperative societies. It largely depends on the areas in which it has been functioning. So Reserve Bank has also got the regulating authorities where it prescribes the capital adequacy ratios and the income recognition, loans and advances that are to be given, and the kind of exposure that they can be given to various entities. Okay. So these are the things that are there in this one. And coming to the classification of the urban cooperative banks, these are classified as grade 1, 2, 3, 4, depending on their CRR and SLR are being maintained, and the NPA status that has been maintained by the banks. Okay, coming to the analysis part. As I was saying earlier, so the analysis of the financial status of the urban cooperative banks starting from 2014-15 to 18-19 were considered, and during this analysis, these are some of the figures which have been identified during the analysis part, and it has been observed that the total credit that has been disbursed to the priority sector was around 1108 crores, which has been increased to 1547 billion, registering a growth of around 39.64%. And similarly, coming to the microcredit amount that have been disbursed during this period, from 48 billion in 2015 to 218 billion by 2019, registering a growth of 346%. So it has been observed that subsequent amounts have been disbursed to the priority sector by the urban cooperative banks, and in percentage wise also they are good when compared to the other commercial banks or the RRBs, especially while dealing with the rural segments of the society. Okay, and the other thing that has been there where the observations are the deposits and the advances which are been given by the various banks, which are been segregated as tier 1 or are been rated as ABCD, where the bifurcation was been said earlier. So it has been observed that the B ranked UCBs have the highest number of banks, and these have got the highest amounts of deposits and advances when compared to the other rated UCBs during this particular period. And when it is been considered for the tier wise branch segmentation, it has been observed that there is a continuous decline in the number of tier 1 branches from say 1132 in 2015, and it has come down to 917 branches by 2019. So whereas in contrary to the tier 1 branches, there is it has been observed that there is a continuous increase in the number of tier 2 branches, which has been risen from 447 to 627 by 2019. So similarly, while taking the deposits, the majority of the deposits are from the tier 2 branches when compared to the tier 1 branches. And similarly, in advances also, the tier 2 branches have been performing more when compared to the tier 1 branches. Okay, these are the some of the financial parameters of the urban cooperative banks, which has been under the consideration for the study period. Okay, it has been observed that a subsequent decline in the financial indicators like the ROA or ROE over the years, which is giving a negative impact on the overall financial performance of the urban cooperative banks. And similarly, pertaining to the NPAs also, the gross NPA as well as the net NPA is been increasing in terms of amount. But when it comes to the ratio wise, there is a there is not a much increase in the net NPA position, but the gross NPA position has been increasing over the years, which is giving a negative signal for the functioning of the financial bank. Okay, when it coming to the capital to risk weighted assets ratio (CRAR), which determines the capacity of the banks in absorbing the risk, it has been observed that majority of the banks have been with the higher CRR, indicating that the banks have been better capitalized, and they are in a position to ensure that the risks are being taken place by the banks over the period of the time. Okay, I come to the last slide. We have taken the ANOVA test for ensuring the factors which have an impact on the overall functioning of the urban cooperative banks. So it has been observed that deposits has got the highest mean and the highest standard deviation, which determine that this is the factor which influence the other factors which are considered under the construct. And at the same time, the branches or the ATMs or the districts with which the urban cooperative banks are available, it is found that there is significant relationship between these and the significance factor is less than 0.05, where we consider 95% of accuracy. So these factors have got an influence on the overall functioning of the urban cooperative bank. While the factor like the UCBs where the districts, that is the districts where the UCBs are not available, are found to be at a higher value. Means this particular segment of the district have not got much influence on the overall district. So coming to the solutions, it has been observed that proper care has to be taken while discussing the credit to the customers. Otherwise,
One more minute,
there
please.
is a chance. Yeah, if proper care is not been taken while discussing the cost as paid will be at a serious stake. Proper evaluation is in place for evaluation of the places is required before opening the branch. It's been observed that these have been opened with UCBs across the countries with a shorter proximity. So this needs to be considered. That is proper evaluation. UCBs are really the objectives to tax.
Okay, can we now go to the next? Thank you, Dr. Mohana Krishna, Irinki, for that presentation on the eminence of urban cooperative banks in India. Now we go to the next paper, which is I already made all the three authors co-host. Next is between tax buoyancy and economic growth, evidence from India, by Dr. B. Suresh, Dr. T. Ravi Kumar, and Mr. Rajesh R. All the three of them are from the Christ Deemed to be University, Bangalore, Karnataka. Please go ahead. Kindly switch on your video so that we can take a picture of all the three of you.
Yeah, thank you, sir. First of all, I would like to express my sincere gratitude to the Indian Institute of Finance for accepting our paper and allowing us to make presentation over here. So respected jury members and respected panel of experts and my co-participants over here. The title of the paper which I'm going to present today is The Nexus Between the Tax Buoyancy and the Economic Growth in Evidence from India. So this paper is co-authored with Dr. Ravi Kumar and Professor Rajesh, and we are from Christ University, Bangalore. This is brief about the abstract of my paper. So I want to take you through the brief introduction. And yes, we all know that various countries across the world, they depend on tax revenue when it comes to financing for their fiscal activities. So in order to generate the revenue, they have to have an effective tax collection system in place so that they have a better compliance rate and also better revenue collection. To assess the effectiveness of the tax system, one of the indicators that we generally see is that their country's tax buoyancy rate. So tax buoyancy rate is the key indicator which brings out the relationship between the tax collections and the economic growth. And generally we look at a higher tax buoyancy rate resulting from the increased economic activities. But that is not the case in most of the emerging nations. There are a lot of concerns with regard to the maintaining of a sustainable buoyancy rate. When we looked into the body of literature which are already existing, we found a mixed evidences, and some of the important literatures have been listed over here. And yes, very few things I would like to mention over here because of the lack of time. So one study which I can really bring it to the notice of all the panelists here is that the work of Debasys Patnaik, who studied the elasticity and variation in buoyancy of the direct and indirect taxes in India, and finds that the corporate tax and income tax are highly elastic in nature, and it is proportionate to the changes in the GDP. It might be possible with no revision in rates, and still, there could be an increase in the tax revenue as compared to the increased economic activities. So also we have found, various other articles which have, directly or indirectly dealt on this particular topic. But there is a clear, gap in terms of understanding the trends in the revenue collections in India, and also its correlations with the tax buoyancy rate and the economic growth of this country. So in order to fill that gap of knowledge, this study was initiated, and this study basically intends to find the trends in the revenue growth and the tax buoyancy rate, and also it attempts to verify its linkages with the economic growth. For this purpose, the data has been collected from the published sources of Government of India for the period between 2000 to 2018, and annual time series data is what we have used in this, and descriptive research methodology which has been used using the annual data, and statistical tools like descriptive statistics, trend analysis, Pearson's correlation, and the linear regression model has been used to verify the relationship between the tax buoyancy and the GDP growth rate in India. Tax buoyancy has been computed using this equation, that is the delta x1 divided by the delta y1. Here delta x1 is the change in tax revenue divided by the change in the GDP growth rate. This study also considers the net tax collection both at direct and indirect tax level and the GDP growth rate. And GDP growth rate also has been considered at the annual level. And also the other parameters like the direct tax GDP ratio, then GDP growth rate, and tax to the government growth rate in order to understand the revenue pattern and the tax buoyancy. To verify the relationship, the following two equations have been used. And here the x dt denotes the direct tax revenue collection, and the YT being the explanatory variable on the total tax revenue at the direct tax level, and similarly on the indirect tax level. I have shared my statistical tables towards the end of this slide. I would like to directly take you through the empirical findings of my research and some discussions based on my research findings. It is observed that the mean GDP growth rate in India for the last 2 decades was 12.7%, and the direct tax growth rate was slightly higher compared to the indirect tax growth rate. So it was 17.36% as compared to the indirect taxes, which was around 13%. We also find in our study that there is no significant mean difference in the direct and indirect tax percentage contribution to total tax revenue, and also that there is no significant mean difference in direct tax to GDP and indirect tax to GDP ratios. Notably, there was a surge in the tax revenue collection since 2002 compared to the previous periods, and it continued to rise in proportion to GDP growth rate. Also, the aggregate compliance growth rate is steadily growing over the last decade and has touched double digit. As per the provisional data of 2017-18, we found that the direct tax collections was increased to 18.2%, that was highest in the last 2 decades, as compared to the immediate previous period of 17.25%. The direct tax collection was also increased over 40% for the first time since 2002 and 3, and it was mainly attributed to the increased personal tax return filings. In an emerging economy like India, yes, it is not expected that we find more government dependency on the tax direct tax revenues. It is expected to have a balanced approach between the direct and indirect taxes. Interestingly, here we find that there is a significant percentage change in the growth in direct tax as compared to the indirect taxes to the total tax collections. And yes, there is also a point to be noted here that the direct tax collection for the first time has fallen below 50%, despite revenue reforms initiated by the government of India and various other reforms which were taken up during those periods. Still, the direct tax collection has dropped significantly. It is increase in indirect tax revenue collection was also mainly here, found mainly due to the increase in tax collections in terms of the service taxes, and increased economic activities also has contributed for the growth of indirect tax collections. It means that in India, an increase in GDP is not necessarily added to the tax revenue collection significantly. We find that the indirect tax buoyancy rate is weaker compared to direct taxes in the last 2 decades. And it was higher only during 2010 and 11 and 15 and 16 period prior to the introduction of the goods and service tax in India. However, post GST implementation, there is a considerable increase in the indirect tax compliance rate, and the tax buoyancy in indirect tax has also gone up significantly. Yes. We note clearly through our study that the indirect tax buoyancy has touched dramatically in the last decade, especially from 2010 and 11, and it is growing at a faster pace, and post GST implementation its growth rate is considerably higher. Prior to this period, the overall tax buoyancy was dependent on the direct tax collections, and now it is witnessed that there is convergence of direct and indirect tax. In fact, indirect taxes are contributing now little higher as compared to direct taxes. But nevertheless, we can find that the direct tax and indirect tax now it's more or less around 49.6% to 50%. There is a convergence which is going on. Probably in the coming days, with the increased economic activities, there is a chance that that due to the highest GST collections, the dependency on the direct tax revenue might go down. We also have found that during the high growth period, that is between 2004 to 2008, the direct tax buoyancy was averaged to 2, but declined drastically during the recession period, that is post 2008. Conversely, the indirect tax buoyancy increased during these periods. So whenever there is a decline in the direct taxes, we see that the indirect tax rates are increased, and that is balanced for managing the fiscal deficit. The tax to GDP ratios depict the revenue relative to its gross domestic product. Countries like India also resort to increase the tax to GDP ratio when there is a fiscal deficit. It has been seen in various periods in the last 2 decades in India also. We find strongly that the direct tax to GDP ratio in India is greater compared to the indirect taxes, and the direct tax buoyancy factor has touched peak in the early 2008, but after that it has come down drastically. The global economic slowdown and other macroeconomic factors caused the slowdown in the tax collections. And we also find that it is not proportionate to the GDP growth. And we have made a qualitative analysis and found what is the reason for that such an unstable tax buoyancy rate. We found that mainly because of the regulatory interventions which are not effectively implemented. Yes, there are policy interventions made like the landmark attempts right from beginning of the economic reforms in the year 1991. We found that yes, there are changes in the tax collection rates positively, but it is not sustaining. So that is the major interventions, and very recent interventions from the government in order to boost the tax buoyancy is the demonetizations and the GST. So, but the real impact of it is yet to be captured. Since my data here, it is still 2018. Probably it is too early for me to comment on the real impact of the GDP, the real impact of the demonetization and the GST collections. But we can see there is a dramatical increase in terms of the income tax returns filing and also the GST compliances. Now to conclude, yes, I would like to bring these points to the attention of the readers here. Yes, through our study, we find that in the last 2 decades, there is an uneven growth in the revenue. But yes, we can see that there is a strong convergence going on, and the GDP growth rate and the tax revenue has no long-term relationship in India, because we see that there is a very weaker R-square value, and that indicates that yes, GDP and the revenue, that is tax buoyancy here, has no direct relationship. There is no much influence on each other, which is not expected. Yes, but efforts has to be made to increase the tax buoyancy in line with the GDP. So despite many reforms, this trend is still continuing, and there has to be more persistent interventions required from the government side in order to increase the tax buoyancy rate. Yes, the empirical evidence of IMS study report very clearly says that in order to have a consistent growth, having a long-term tax buoyancy is very imperative. So that is yet to be achieved in the Indian markets. So we conclude that that there is no support for the proposition of increase in GDP, which leads to increase in better revenue collections to the government. And finally, the tax buoyancy is still a major concern in India, which needs to be addressed to more systematic regulatory interventions. So these are all some of the tables and the graphs that I have presented in my research paper. Yes, thank you. And I thank the Indian Institute of Finance for giving me this opportunity. And we look forward for constructive feedbacks. Thank you.
Thank you, Dr. Suresha, Dr. Ravi Kumar, and Mr. Rajesh. I go to the next paper. I would request them to kindly start their videos as well as their presentation. The next paper is on an analysis of virtual world of education during COVID-19 with respect to management institutes of Mumbai by Dr. Kuljit G. Khelon from Guru Nanak Institute of Management Studies and also Dr. Kamini Khanna from the Guru Nanak Institute of Management Studies. Please go ahead with your presentation, madam. I would request Dr. Kamini Khanna to also switch on her video so that we can take a quick photograph while the presentation goes on.
Thank you, sir. Okay. Shall I start, sir?
Please go ahead.
Okay. Very good afternoon, one and all. My name is Dr. Kuljit G. Kalo and my co-author, Ms. Dr. Kamini Khanna. It is a great privilege to present our research paper on the topic, an analysis of virtual world of education during COVID-19 with respect to Management Institute of Mumbai. The flow of presentation is introduction, keywords, challenges in virtual world of education, literature review, research gap and objective, research methodology, result and discussion, conclusion, limitation of study and scope for further research. As we all aware, this COVID-19 lockdown period thought of challenging in personal front gave us many challenges and learner as well as academicians. This pandemic period has made young as well as the aged faculty to sit in front of laptop, computer, mobile, iPad and learn to use them to each and every aspect because all the escape routes are closed. The keyword, the virtual education, digital technology, pressure on the faculty members, learning new IT skills. The challenges in virtual world of education. It is famous saying by the great philosopher, I hear and I forget, I see, I remember, I do and I understand. Currently, most of the faculty are delivering lectures and all the students are doing is hearing them. Hence, the greatest task lies in motivating the students to learn and make them participate in the discussion. Faculty need to think out of the box to create an environment which inspires and motivates students to learn. Faculty face in the virtual classroom setting, especially with management students, is that the students are easily distracted. The faculty are also overloaded with many other academic tasks like admission work, accreditation work, ranking system, and many more. So literature review. The extensive literature review has been undertaken by us for this research paper. Research gap and objective. Although various study reveals different aspects of virtual world, no study yet has been made on the topic of virtual world of education in Management Institute. This paper tried to identify the problem faced by the academician in the virtual world of education during COVID-19, and it is expected that the study would assist to make suitable policies and strategy to bring out conceptual transformation in higher education institution where each mode may become e-competency related and equity to marks returnics. Research methodology, the study was descriptive in the nature and survey method was used to complete the study. The population of the study comprised specifically the faculty of Management Institute Mumbai, and there are around 120 management institutes in Mumbai. The convenient sampling technique selected 100 sample. For data collection, a self-designed questionnaire Google form was administered, and the period cover for the study from May to July 2020. The data analysis through SPSS, the reliability was determined through Convex Alpha. The reliability analysis was employed to test the consistency level of relationship between group of the statement designed in the questionnaire. And the questionnaire structure, the questionnaire consists of 4 sessions starting with the journal information about the respondent like a demographic data, and the session 2, the different questions were asked regarding conducting online lecture on different platforms and satisfaction level of the faculty. And the third session, The different questions were asked regarding facing any problem, conducting online lectures, and fulfilling other institution tasks. And in the fourth session, the different questions asked were regarding the learning new IT skill and conducting online assessment, delivering the session, or any other task. So emerging factor affecting virtual world of education, and there are 41 variables. Depending upon their proximity, they have been clubbed under 5 factors and renamed as faculty dilemma, dark side of the world of virtual education, malaise of online education, technical problem, and enhancing the digital knowledge. Factor
Dr.
analysis
3
is
more minutes.
okay, sorry. Factor analysts state that there are significant in virtual world of education, and that result reveals that the most important factor affecting virtual world of educations are faculty dilemma and dark side of the world of virtual education. So faculty dilemma, the faculty is struggling literally to manage teaching and assessment part of online education. Faculty on one side have to develop study material, PowerPoint presentation related to their topic, and in the other side have to be create online assessment and question paper during midterm exam. Seeing the proximity of the student to use the word, their uses more than one device during exam create more challenge for the faculty to prepare such type of questions which cannot be easily answered with the help of Google search. And the second most important sector, like dark side of the virtual world, students do not reply when faculty ask question. They are using alternative device for test. They are not serious about the lecture. The focus is on the attendance, and they are exploring the new way of cheating rather than exploring the books. And it is an illogical situation where hard work of the faculty is being avoided by the new cheating method. So we can say that the students are digitally present and physically absent. So I would like to conclude here. The pandemic crisis has upset objective of access, equality, excellence in the education sector, and made online teaching and evaluation as new norm, thus creating the digital divide. The call for switch over the virtual teaching learning evaluation pushed the huge number of teaching faculty into an unfamiliar mode, and the massive shift to the online mode will be the turn mode to be made one-third of the teaching faculty unnecessary, which may be adopted for the cut in public expenditure. But virtual teaching is never substitute for the real that has exclusive advantage of the being real. The study analyzed that the post-COVID higher education will be slump further, behavior stumbled on the campus on the online devotion of the professional. So the limitation of the study is confined is that the state of Maharashtra. Therefore, the result may not be representative for the country as whole. And although there is a possibility of the applicability of the conclusion about teachers to other part of the country, no such general applicability beyond the respondents of Maharashtra is claimed. An interstate study can provide a better glimpses of the Indian perspective. And the scope for further research, among the higher education sector, only the teachers of professional institute were selected as a universe of the study. The college and school teachers were not included as their responses would have been the different from student pursuing professional course. Therefore, the viewpoint of the college and schools teacher would not included, which could be studied in future studies. So that's all from our end. Thank you so much, sir, for giving the great opportunity to present our paper. Thank you, sir.
Thank you very much, Dr. Khelon and Dr. Khanna. We move on to the next paper, which is a study of financial literacy and its impact on investment behavior during the lockdown period by Dr. R. Ananta Lakshmi and Mrs. G. Madhumali from Sona College of Arts and Sciences. I would request them to kindly switch on their videos as well as start their presentation. Yeah, if you can kindly start your presentation. Yeah, please go ahead.
Good afternoon to the distinguished dignitaries and participants of the IIF virtual conference today. I'm Dr. R. Ananthalakshmi with my co-author, Mrs. G. Madhumati, to present our paper on a study of financial literacy and its impact on investment behavior during the lockdown period. So first we will see our introduction. The COVID-19 global crisis not only has shook the Indian economy, but also the global economies to a very large extent. So some of its major impacts are reduced productivity of various products, loss of human life, then different business closures, internal and external trade disruption, and mainly the depreciation of the tourism industry and the like. So although India has tackled the spread of virus, this pandemic has disrupted the normal day-to-day activities and the life in the country largely. Business all over the nation are very susceptible to the unfolding economic crisis. Sudden loss in the incomes of people is causing a major drop in demand and shrinkage of economic activities. So the decline in domestic consumption has changed the future business activity, and it also has caused a probable decline in the investment behavior of the people. So next we move on to the need of the study. So this COVID-19 is not only a global pandemic and a public health crisis, but it has also severely affected the global economy and financial markets. It has caused direct impacts on the income due to premature death, workplace absenteeism, and reduction in productivity, then mainly global supply chain disruptions and closure of factories. So this financial stress among the people impacts their emotional and physical well-being. So financial literacy, it mainly refers to the ability to use the knowledge and skills of a person to manage his or her financial resources effectively and also to make informed investment decisions. The financial literacy of an individual helps to make quick decisions, slow a free fall, and propel finances towards normalcy. Therefore, this research has been an attempt to study the level of financial literacy and its impact on the investment behavior during the lockdown period. So next, we see the objectives of the study. The main objectives of this study are to study the level of financial literacy among the investors in Salem district, to study the investors' preference towards various sources of investment available to them during the COVID-19 lockdown, to study the pattern of investors' investment behavior during COVID-19 lockdown, and to study the emergency fund availability among the investors. So next we move on. These
Please go ahead. Dr. Ananthalakshmi, we are not able to hear you. If you can kindly just check. Dr. Ananthalakshmi, if you can hear. Dr. Madhumati, if you can, yeah, she's come back. Please go ahead.
1 minute.
Sure.
Okay. Are you okay? Then the research instrument used for the study is a questionnaire. Then we used both the primary and secondary data resources, and the secondary data were mainly collected from the website article, online newspaper articles, and other newspapers. The scope of the study is from the Salem district of Tamil Nadu in India. Next one. The next one, framework of analysis. So we have used the following 4 analysis in our study. They are the percentage analysis, one-way ANOVA, cross-tabulation, and the chi-square test. So next, if we see the results and discussion, we'll just see briefly about a few tables. So the first one shows the level of financial literacy. So from our study, we can clearly see that a moderate level of financial literacy is seen among 65% of people, and the next 18.3% of people have low level of financial literacy, and only 16.7% of people have high level of financial literacy. So next one, if you see the emergency fund availability among the people studied for the survey, around 56.7% of the people had their emergency fund during the COVID-19 lockdown, and only 43.3% of people did not have any fund. So next, if we see the chi-square test, we can see the relationship between financial literacy and the source of investment. So the null hypothesis is rejected, and there is a significant relationship between the level of financial literacy and the source of investment, the awareness on the source of investment. So the second one, if you see the same level of financial literacy with the emergency fund availability, the null hypothesis has been accepted. So next, we move on to the findings. These findings are from our research. So if we see, most of the respondents of the study, that is 61.7%, belong to the age group of 26 to 50 years. Secondly, 20% from above 50 years. Then 60% of the respondents were female. Then most of, that is 68.3%, of the respondents have their college level education up to their undergraduate or postgraduate degree. Then majority, 35%, earn a monthly income of rupees 25,000 to 50,000. So out of the respondents, when we studied what was their main investment objective was, few of them said that is equally of around 28.3% of them said that they want a high return from investment or moderate return from investment. So secondly, 26.7% invested because for their safety measures. Then if we see, as we saw in the results, majority 65% have moderate level of awareness on all the aspects related to financial literacy, an idea on all investment options. Then there is a significant difference between the respondents' level of financial literacy and the awareness on certain investment options. It is found that people with high and moderate level of financial literacy invest in equity and preference shares, then mutual funds and insurance policy. Then from the study, it was also identified that the respondents with low level of financial literacy invest in post office scheme, and moderate level of financial, and people with moderate level of financial literacy invest in fixed deposit, and people with high level of financial literacy invest in mutual fund. So as we already saw earlier, majority 56.7% had their emergency fund during the lockdown, and the majority 65% used their bank savings in case of their requirement during the lockdown. And the other alternative options used by the other respondents were jewel loan, new loan from bank, then borrowing money from others. The last one, majority 56.7% were not able to save any money during the lockdown for their investment purposes. So mainly if we see, emergency fund refers to the money set aside to cover large unexpected expenses in the bank account or in hand by the respondents. So finally, to conclude this with the suggestions and conclusion, earlier, various economic economists attempted to establish the relationship of financial literacy with various financial behaviors. However, this has taken a great collapse during this global emergency. So in the study, we can see with the regard to relationship between financial literacy and financial behavior, it was found there is an association between respondents' level of financial literacy and their emergency fund availability. The financial literacy level affects awareness of respondents regarding financial products as well as investment preferences towards financial products. Due to escalated financial education of the investors nowadays, with the help of the financial education providers, the other investors and policy makers, and also the regulatory authorities, the investors were able to maintain an emergency fund which helped them during the crisis. So having a financial literacy program organized by the government for the investors with low level of knowledge, it would help them to take better financial investment decisions, which can also help them to increase their productivity and also save the cost of their healthcare and efficiently manage their financial resources during the normal and pandemic situation. But however, during a pandemic situation, it is the responsibility of each and every investor to invest or safeguard their savings in a potential manner. So thank you for providing this opportunity. I thank the IIF people for providing this wonderful opportunity to present our paper. Thank you.
Thank you, Dr. Ananta Lakshmi and Ms. Madhumati.
Yes,
Madhumati. And the Sona College of Arts and Sciences for presenting this paper. We go to the next paper on examining asset pricing model in Indian stock markets. Everybody is requested to kindly stay back because we have referees who are going to come. Some of them have I'd like to welcome Dr. Kaur, who has just joined, Paranjit Kaur, who has just joined us about 15-20 minutes back. They're going to be there to present their views on your paper. So please, all of you are requested to stay back till the end. We have now paper by Dr. S. Durga and Dr. P. Venkatesh Rao. I was not able to find Dr. Rao. If he is there, if he can raise his hand so I can make him a co-host as well. From the Kenur Lakshmahi Education, KL Education Foundation, KL University, Andhra Pradesh. Kindly begin your presentation, and if Dr. Rao is here, I would request him to kindly raise his hand so that I can make him the co-host, as I was unable to find him in the list of participants.
Sir, is it audible? Yes, sir?
You're audible. Please go ahead. Kindly switch on your video so you can take a picture. And do you have any idea if Dr. Rao is here?
Sir, I think he's in another meeting, sir. He'll join within a couple of minutes. Sir.
Okay, fine. Thank you. Please go ahead.
Okay, sir. Good afternoon. A very good afternoon to one and all. So I feel it a very I feel very honored to be a part of this international conference. So I just thank all the people who has given me an opportunity to present before you this paper. So, and I've done a paper, I'm going to present a paper on examining the asset pricing models in Indian stock market, co-authored by Dr. P. Venkatesh Rao, and he's the professor and HOD and KL Business School in KL University. So, as we all know that finance is a branch of economics that focuses on the capital markets. So initially, this emphasis was placed on describing the market environment and valuing individual securities. But during the last 3 decades, attention has switched towards the broader aspects of valuation. So that is the main. 1 second, sir. Yes. So one among these models are these asset pricing models, and which helps, and this theories helps the investor to understand the risk and return realized for any of their investment. And this series also tries to explain how 2 different stocks give varied expected returns, and also explain how these returns change over time. And over the past few decades, a number of valuation methods, as I said earlier, have been developed, like CAPM, that is capital asset pricing model, APT, that is arbitrage pricing theories, and Fama French 3-factor models, and etc. So out of all these things, capital asset pricing model is different from the typical Fama French 3-factor model and APT, because the CAPM measures the risk in particular way, where these other 2 suggest that there are many other sources that contribute to the returns of the asset. So because of the time constraint, I'm not going to read out all the earlier studies, but I have reviewed the earlier studies right from this 1973, like Black, Jensen and Scholz papers I have reviewed. And I have collected the evidence from the world markets in support of the 3-factor model, because this 3-factor model has been proved to be superior than CAPM or APT. So, and some more works I have reviewed, and finally, I have reviewed the studies. I have segregated the total studies from the Indian context also, and I found these studies, that is in 1988 and 1993 and 2000 and 2003. So, and from these earlier studies and review of literature, I have identified this research gap. So that has made me interested to carry on this paper. So that is, there is a, so majority of the studies which I have reviewed have been undertaken in the developed markets. So, and almost all the researches, they were conducted only on CAPM, especially in Western countries, and all of them dates back to early 90s and 2000s. And if you just observe the earlier studies, very few studies they were conducted in India, and which are showing, and that too they were showing diverse results. And when coming to the multi-factor models like 3-factor models and APT, so these empirical works are rather sparse in developing economies or the emerging economies like our country. So I thought there is a need for more sample tests, especially relating to these emerging markets, and especially a country like India. And always studies or these emerging markets like India always gives a challenge to the current asset pricing theories. So always there is a scope for us, for a country like India, to examine and to re-examine these asset pricing theories. So, and because these markets, why? Because these markets are very much volatile and does not follow these theories due to incomplete market integration. And so I thought there is a need to re-examine, and I just want to test the validity of these 3 models in Indian stock markets. So my the present paper focuses on re-examining the asset pricing models in Indian stock markets. That is my research gap, and that motivated me to continue this research. And I have set my research objectives like this: to re-examine the legitimacy of CAPM and multi-factor models in Indian stock markets, and to measure the efficiency of French 3-factor model in the Indian stock exchange over the period of 2009 to 2018, and to examine whether high earning price ratio and small firms and high debt equity ratios and high book to market equity ratios have an average returns that are not captured by their betas, and to study whether the market size and value factors are pervasive in cross-section random stock returns. With the said objectives, I have collected the data. The required data for this present study is secondary in nature, and the study was conducted using the data from January 2009 to 2018. And the selection of the stocks was made on the basis of the membership in S&P CNX Nifty as on 1st January 2009. And I have collected 100 stocks, and we excluded where data is not available continuously, and those that are merged and acquired, after which we are left only with 87 stocks. And the study used monthly stock returns for the sample companies, and the prices from NSE were obtained from CMIE Provis database. And the risk-free rate was taken as the implied yield on the monthly or end auction of 91-day treasury bills, and it was obtained from RBI Bulletin. And the data regarding SML and HML factors, they were collected directly from J.R. Verma web page of IAM. And the methodology I have adopted for 3 models is BJS methodology, which is very popular, that is Black-Jensen model. And which this method uses individual stock betas to rank the universe of stocks which we are interested in. And I have given this methodology of BGS. So it takes into consideration the time series regressions. And so the methodology I have adopted goes like this: that is, all stocks on S&P from 2009 to 18, and data availability issues restricts sample to 87 out of 100 stocks for the specified time period, and estimated the beta for each stock in the first 5-year regression window using time series data, and rank order all of the stock betas, and formed 10 portfolios. And the first portfolio contained 35 stocks associated with the highest estimated betas, and portfolio 10 contained 36 assets with the lowest estimated betas. And after that, calculated each of the portfolio returns for each of the 12 months in a year directly following the first 5-year regression window. and after that 5-year regression window forward by 1 year and repeat these steps to second and fourth step for this new subset of data across all regression windows. And totally we are left with we found with 13 regression windows with 10 portfolios in each of them, and join identically numbered of portfolios across regression windows, that is portfolio N in regression window I with portfolio N in windows J, to yield 10 portfolio time series. And estimated time series regression of portfolio returns against excess market returns for the remaining monthly data in the data set. And estimated the ex post security market line SML via a cross-sectional regression of mean portfolio returns against portfolio betas estimated in the previous step.
Durga,
And okay, sir. So this is a methodology for APT, and I have taken into consideration many other factors, economic factors like crude oil prices, gold prices, silver prices, interest rates, etc. So, and I have applied this APT I have tested this APT theory with regression analysis and also multiple correlation also. And for factor portfolios, I have constructed these factor portfolios with the help of this regression line. And I've constructed 6 portfolios, that is small by large and small by medium and small by high, and respective sizes which are required, and which has come to 6 portfolios. And these are the hypotheses. First, that is first 4 numbers goes with the CAPM, testing that CAPM, and the second fifth one is a multi-factor model, that is APT, and the last one is regarding this Pharma French 3-factor model. And these are the tests reported by these regression statistics of Black BJS model, and these are the APT model, and these are the results of 3-factor model. And let me go to the findings or empirical findings. And we all know that CAPM explains the returns of stocks or portfolio of stocks in terms of their systematic risk. And it is observed that the simple CAPM does not adequately describe the stock return behavior. So there are some other factors which will influence the returns of stock. So that those factors are captured either by APT or Pharma French 3-factor model. And coming to my findings, the CAPM prediction for the intercept is that it should be equal to 0. And the findings of my test confirm the hypothesis formulated. So I found a partial application of this CAPM in our Indian stock market, but not completely holds good in our Indian stock market. And in fact, it is noted that betas, they are found to be highly significant, but the risk return trade-off implied by CAPM, it's not observed according to my study. That is high risk portfolios giving high returns, and it is not observed. So, and even in the case of individual securities also, the study revealed that the intercept is not significant, showing evidence of CAPM, and it holds good only partially, in the sense that market risk premium is significant explanatory variable. And it also predicts that there is a linear relationship with its systematic risk, and the findings of that test are in contrast with the above hypothesis and indicate inconsistency with the CAPM. And according to CAPM, the stock expected rate of return is only affected by systematic risk and has no relation with non-systematic risk. And coming to the macro APT findings, it was found that macroeconomic factors have limited impact on stock return based on the data collected by me. And coming to the 3-factor model, only SML, small, medium, large of the 3 Pharma French factors do not have significant impact on stock returns. And a HML, that is high, medium, low, it is having a occasional influence on portfolio returns. And it is also concluded that APT to be a suitable descriptor of asset prices or excess portfolio returns in Indian capital markets. While APT specifies no particular it has not specified any single factor which is to be considered for such an application of the model. And it is observed that silver is highly correlated with gold and oil prices, and further gold and oil prices, they are also highly correlated by the multiple correlation I've done. And the results of three-factor model reveal that model is fit where regression statistics where that R square is more than 80%, and all regressions have very high R squares indicative of significant explanatory power for the independent variables. And it also, it may not hold exactly, but apart from market risk premium, that is price to book value ratio is a good explanatory value of describing stock returns. And the results of three-factor model shows that P by B is a significant explanatory variable, and size is not a statistical significant variable. And it is also observed that market risk premium is a significant variable in the case of all these portfolios, and HML is having an occasional influence on portfolio returns. And the market risk premium is significant explanatory variable in all the 10 portfolios with T value greater than 1.96. And hence I can conclude that corporate managers can use this CAPM and consider using Pharma-French factor model to calculate hurdle rates for corporate investments to estimate their required returns. So till now they are being using only CAPM to estimate their required returns, but now onwards we can use this three-factor model also to estimate the required returns. And cost of capital also can be used, calculated with the help of this Pharma-French model. And they can start using, even though it is quite common to use this CAPM, but they can start using this Pharma-French three-factor model also. And in Indian regulators of public utilities, banks use CAPM to determine the cost of equity for the utility under consideration. And investment practitioners had been using CAPM to select stocks, to construct portfolios and evaluate portfolio or stock performance. And even for these purposes also, Pharma-French three-factor model may be used as it is observed to outperform the CAPM. So this is the end of the paper, and I thank all the people for giving me this opportunity.
Thank you, Dr. Durga, Dr. Rao. We go to the next paper today, which is Test of Indian Industry Indices amidst COVID-19 pandemic, an event study analysis by Dr. Lakshmi Rawat from Mala Reddy University, Hyderabad, Telangana. Dr. Rawat, kindly, you can start your presentation.
దీని గురించి నాకేం లేదే అన్నారు కానీ ఇంకా పెట్టల.
Yeah, Dr. Rawat, please begin. You're not audible, please. You're not still audible. We can see your PPT, but not your voice. Can you try unmuting yourself again and maybe it works? Have you connected by another device? Because I do see another Lakshmi Rawat here, which I made co-host. Can you try unmuting that one, please? No, we are not able to hear you. I made you co-host, so you should be able to unmute yourself there. Can you do that?
Yes.
Yes, we can hear you.
Am I audible now?
You are audible now.
Give me a moment.
You'll have to shut one device because otherwise it will keep echoing. Yeah, go ahead.
Hello.
Yeah.
Is it echoing now?
Yes, it is echoing because please put the mic in the other device also. Then it will not echo.
Hello.
Can you speak now? No, this device mic is not working. If you just put the any wire so that the echo doesn't take place. No, we are not. Please unmute yourself now, which I have sent just a request to the other device.
Yes.
We can hear you now, but if you can put this wire, this telephone, the mic wire in the other device also, so then the echoing will stop.
Give me a moment. Hello.
Yes, better.
Now it's okay. Okay.
Perfect. Go ahead, please.
Please accept my apologies for this technical glitch. So
We're
this is
all
Dr.
still
Lakshmi.
evolving ourselves. All of us are. Please go ahead.
Okay. So this is Dr. Lakshmi from Malla Reddy University, and my paper is on the test of Indian industrial indices amidst COVID-19 pandemic and event study analysis. One second, sir. I'm not able to move my PPT.
How about I move to the next paper in the meantime, if you can fix this technical glitch part? Yeah.
Okay, I think I'll present from my handset and share the screen from that. Please go ahead with the next presentation.
Yeah. Can I request Ms. Sukanya and Dr. Suresh Ji to make the presentation, start the presentation on India's outward FDI macroeconomic determinants of home country by Ms. Sukanya R, who is from NMKRV College of Women in Bangalore, Karnataka, and also a doctoral student at the Christ deemed to be University, Bangalore. And Dr. Suresh Ji is teaching at the Christ deemed to be University, Bangalore. Ms. Sukanya, kindly begin your presentation, and Dr. Suresh, if you can kindly turn your video, and I think I did make you the, I'll just make you the co-host, please. Just a second. Yeah, Dr. Suresh, if you can turn your video on as well. Just a second, Ms. Sukanya, just a second, please. You can unmute yourself now.
Thank you, sir. So I'll directly start with the presentation now.
Please. Dr. Suresh, if you can kindly keep your video on for some time.
Sir, are you able to see the screen?
Yes, please.
Okay. Good afternoon for all the panel members and also the reviewers and the co-presenters who are present for the conference.
Please go ahead.
Sir, are you able to see the screen?
I'm able to hear you. I'm able to see your screen. Please go ahead.
Okay. Thank you, sir. So the topic today, I'm a research scholar as well as the assistant professor in NMKRV College and the research scholar of, excuse me, sir.
Yeah, I'm able to hear you, but I can't see your screen now.
Just, sir, can you just give me a second?
Sure, sure. Dear friends, in the meantime, while we are getting connected with Ms. Sukanya starting the presentation, let me just tell you again, please, all of you requested to kindly stay back. The referees are here, and we would be having them present their work in a few seconds in terms of their review reports to you. So, request you kindly stay back. Also, all the referee reports from the referees from overseas in India would be sent to you next week, in the following week, along with your certificates. So kindly have the patience. That will be done towards the end of the next week. And we give you about 3 weeks to revise your papers and resubmit them to us. If either of you are ready, please, if you could begin.
Apologies for the technical glitches due to
No
the
problem
heavy
at
and
all.
slashing rain. So I'm going to start with my paper is on India's outward FDI. I'm going to deal with specifically with the macroeconomic determinants of the home country. Starting with the introduction is the FDI. So initially the FDI has been traditionally accepted in bulk from the upper middle income countries for the lower middle income countries and the emerging economies. But later on with the gross border flows in goods, investments and ideas, which is led by the MNEs from the emerging economies, have strengthened in the recent decade with diligent technical progression. And as a result, the emerging markets have been with intensifying their growth in the emerging markets and the slowdown in the upper middle income countries. An increasing share now comes from the MNEs, which is based in low and middle income or the emerging economies. As a result of which, the growth of the emerging markets, the global FDI has witnessed both a decline as well as a growth. The global FDI has witnessed a decline in terms of the outward FDI coming from the upper middle income countries, which has fell by 40%, which resulted in a decline of 50% of the global outward FDI or the global FDI. At the same time, there has also been a growth is being witnessed by the global FDI outflows from the low and middle income countries, which has been significant and increasing constantly. So as a result of the global FDI decline and growth, the global markets or the global MNEs have to rethink on their global strategies. Especially the government of the low and middle income countries have started encouraging the outward FDI and facilitating the internationalization of private as well as state-owned firms for their outward FDI, and as it is considered as a significant catalyst. And when we see the literatures furnish an understanding of outward FDI from low and middle and upper middle income countries. But rather it fails to give us fill the significant gaps on the outward FDI from the emerging economies and the trait of such investment in terms of category, drivers, and motivations. So the basic objective of this paper is to escort the awareness to a topic in the context of growing importance, as the major share of OFDI is now coming from the MNEs of the emerging economies in the global FDI. As a result, the outward FDI from the emerging economies and the low and middle income countries has reached a record of $417 billion only in the year of 2018, and which was also being acknowledged by the UNCTAD in the year 2019 in the World Investment Report. And now coming back to the theoretical framework, the theoretical framework was divided into 3 categories. First is the monopolistic advantage, where usually the FDI is seen as a tool for using the monopolistic advantage in the host country from the stances of asset exploitation and asset seeking, as it has been the primary motive for the firms engaging in outward FDI. When we see the asset exploitation, it refers to the transfer of a firm's proprietary assets across the borders and to acquire the strategic assets which is available in our host country. When we see from the organizational perspective, it is suggested that the outward FDI is only an outcome of the firm's desire to improve its return, immediate return, or for its future returns. Similarly, when we see the asset augmenting is being propounded that firms engage in outward FDI to use the overseas market to obtain supportive assets and to enhance their competitive advantage. But whereas if we see the outward FDI which is coming from the Asian MNEs or the low and middle income countries are majorly moving towards the upper middle income countries and are non-price competitive. When we see from the conventional viewpoint, firms' internationalization failed to explain the new wave of outward FDI from the emerging economies and outward FDI activity of the beginner firms. Firms usually move across the geographical boundaries for resource and knowledge-seeking acquisition as well as for capability enhancement, whereas the asset augmenting explains that how the beginner firms are now employing their international augmentation as a way to seek the resources and to overcome their competitive disadvantage. When we see from the firm's point of view, the beginner firms from the low and middle income countries engage in outward FDI only to improve their competitiveness instead of exploiting their existing set of benefits. And therefore, a balance is developed between the asset exploiting and asset exploration FDI is essential for the long-term survival and growth of the organization. Coming to the analysis, for the analysis of the macroeconomic determinants, technology, the variables were technology for which patents were considered, turnover, trade balance or trade surplus, interest rate, exchange rates, and foreign currency reserves. The data were collected from the official websites of UNCTAD, World Bank, RBI, and IndiaStat, and the period was from 1991 to the 2019. The outcome of which is as follows. Technology and India's outward FDI are positively associated. Indian firms' technical input is being reflected in the number of patents that is being issued annually and which is being increasing significantly every year. The income level of India is significant with the amount of its outward FDI. India's outward FDI is more significant with the decreasing trade rate of US dollars against the rupee value. Trade is positively related with the outward FDI of India. A trade surplus is negatively correlated with the outward FDI, whereas if we see the interest rate is negative, as a result, the lesser the interest rate, the higher will be the amount of outward FDI, because usually the amount of outward FDI which is going from India are basically domestic savings. So the interest rates are negative. Rather, if it be the opposite, then the interest rates are expected to be positive, and it is positive according to the previous literatures. The foreign currency reserves are positively related to India's outward FDI. The results are as follows, where we see that the foreign reserves and surplus are expected to be positive and significant at level. The exchange rates, interest rates, and patents are negative and significant at 5 and 10% accordingly, which is indicating that the Indian MNEs with recession advantage initially focus on serving the home market besides promoting the international trade. The strategic motive behind the overseas investment of those firms comprises of asset and technology seeking. The interest rates have a negative correlation with India's outward FDI. The reason is the capital source proceeds from the domestic borrowings. If the capital source comes from the outward borrowing, the results are positive. The negative coefficient conveys that the capital outsources of India's outward FDI are primarily domestic. And the interest rates elevates the capital inflow and outflow internationally, whereas the Indian capital market has a stern control over the flow of foreign currency to ensure the safety of the capital markets. When we see the GNP, which indicates the national income level of a nation, it does not have a direct influence on the country's outward FDI. Rather, it provides an indirect impact on the India's outward FDI and accordingly with the trade variables also. Now coming to the last part of the presentation, that is the summary. And here we see that the exchange rate, although exchange rate is significantly influences, they are not, although the exchange rates are based on the demand and supply, they are significantly influences of the imports and exports. The shift of an exchange rate basket management system leads to a gradual appreciation of the rupee value in the long run, and which in turn increases the purchasing power of Indian currency, acquiring the overseas assets and more attractive to Indian firms. When we see the determining role that is being played by the government, it's encouraging the firms to globalize within the rationale of their own needs and policies. Government policies on outward FDI reflects the country's current political and economic system. The government policies have an impact on the exchange rate, interest rate, and the trade openness of an economy. When we see the basic principles, the literature analyzes the background and the motives for India's outward FDI, focusing on government initiatives. The traditional insight suggests that there are three principal grounds for Indian firms to expand abroad.
We've already gone 12 minutes, please.
Yes, sir. The first is to secure the natural resources to meet the high demand. Second is to acquire the foreign technology and know-how, and then offshore their design centers, globally dispersed R&D laboratories, and third is to diversify their home market saturation and the ruthless price wars. The last part is the Indian MNCs. What is the position of Indian MNEs? In polarity with the global MNEs, Indian MNEs do not seek efficiency in terms of cost minimization in outward FDI. Rather, they are primarily triggered by the pull factors to secure the natural resources, increase their foreign exchange income, circumvent the host country trade barriers, penetrate into new markets, acquire the advanced technical and managerial expertise, and also pursue strategic advantages. The results reveal that the macroeconomic variables such as patents, interest rates, exchange rates, trade surplus, and foreign reserves are the essential determinants of Indian outward FDI. The macroeconomic environment in India plays a crucial role, especially with the shift in the corporate strategy, technology management, human resource, and talent management execution, especially among a small set of globally competitive leading edge firms. With a substantial change in the India's role in the global economy, including the evolution of Indian business from isolation to internationalization and international integration. Thank you.
Thank you very much, Ms. Sukanya R. and Dr. G. Suresh from Rice University and NMKRV College of Women in Bangalore, Karnataka. We move to the earlier paper, which was by Dr. Lakshmi Rawat on test of Indian industries, and this is MS COVID-19 and event study analysis. Dr. Rawat, if you can kindly start.
Sir, am I audible now?
You're very much audible.
Okay, so this is the introduction. Okay, I'm from Mallareddy University, and the title of the paper is Test of Indian Industrial Indices Amidst COVID-19 Pandemic using the event study analysis. For the Indian economy, this has been a special case of crisis with a history of corporate scams in the 2000s, and now we have been aggravated with the cause of this pandemic. The announcement of the Prime Minister for the nationwide lockdown on 24th March 2020 for 21 days also impeded a lot of production, employment, consumption, investment, and other supply chains throughout the transactions in the country. Hence, I found there is a need for the study of the industry-wise segregation and representation of various sectors, classifying them into sectoral sectors from the NSE India and BSE. However, I took on to study the impact of COVID-19 using the event study analysis to understand the spread of this disease and how it has impacted the stock markets in specific. Each sector, each industrial sector, how it has impacted. There are a few literatures available and which had conducted studies on previous pandemics in different countries and the impacts on various sectors. To name a few past pandemics, there has been swine flu in 2009, which had a death toll of around 2 lakh people, then SARS in 2002, Ebola in 2014, MERS from 2015 till date, and maybe the death toll also has risen for this, and COVID-19 from 2019 onwards. And the death toll may also have risen for this. This is the statistics from the WHO, which I have collected about 3 months back. The objectives of the present study are firstly to understand if there has been any impact of COVID-19 pandemic, that is the outbreak of pandemic, the death toll, the first death instance which was announced, and then the announcement of lockdown. These are the 3 events which I have considered for the present study. These 3 events, whether they have had any impact on the industrial sectors of the companies which are listed under NSE 50 and 100. The methodology, this is well known to all of us. Here the event study methodology has been used using the market model, and the estimation period has been taken as 250 days prior to the pre-event period. And the event periods, I have chosen 2 event periods, that is 61 days event periods with 30 days pre-event and 30 days post-event, as well as 31 days event period with 15 days pre-event and 15 days post-event. The model which has been used to calculate the estimated returns is a market model. Now this is about the daily returns calculation and then how the cumulative abnormal returns have been calculated. The abnormal returns have been aggregated and drawn from the daily closing price, which I have taken from the NSE India website as well as Yahoo Finance to confirm on the missing values, that is the missing dates. I'm not spending time on this. The details of the event and the estimation window. The outbreak, the date was 3rd December 2018 to 2000. I think I've missed on the numbers there. It should be December 2019 and 4 December 2000. There's some mistake. I should check that. That is 61 days, and the estimation window was from 30th January. The first death, again 13 December 2018. Okay, this is the pre-event period, 13 December 2018 until 24 December 2019, the 61 days event window. And the date was 13th February 2020. The first lockdown was 24th March 2020. And when I did analysis, it was long back, so I could get the details only for 21 days. That is from 19 February 2019 to 28 February 2020. The data collected for this paper has been, all the closing stock values from January 1st, 2011 until December 2015, and all such ex-dates which were overlapping have been removed from the data. The data has been collected from NSE India as well as from Yahoo Finance, and I have used MS Excel for calculations and SPSS for testing the significance, wherein I have used Wilcoxon test and the student t-test. Okay, there is, okay. The analysis for the outbreak of COVID-19 event, that is, it was found using the t-test. I'm not showing the analysis. I have just presented the conclusions from the analysis which were conducted using SPSS, that is the two-test Wilcoxon test and the student t-test. It was found that for 61 days event window, the Nifty automobile sector had a statistical significant value for Wilcoxon test and t-test for 61 days. That is, it showed that when the COVID-19 pandemic outbreak was there, Nifty auto sector showed some amount of reaction. And with respect to the 31 days event window analysis, it was found that Nifty automobile sector as well as realty sector showed a significant impact. Coming to the analysis which was conducted using Nifty 100 as the market proxy, it was found that Nifty media and Nifty realty sector has had a significant impact for 61 days, and for 31 days it was Nifty realty sector only which showed a significant impact. The second event which was taken was the first death on account of COVID-19, and here for the Nifty 50 being taken as a market proxy, it was found that Nifty media showed a significant impact, and same thing continued for 31 days also. When the proxy was Nifty 100,
because we're already 12 minutes now.
It was found that Nifty automobile and realty sector both showed an impact, but with respect to 31 days event window, none of them showed a significant impact. Lockdown was also lockdown 1 was also considered for as an event, and the testing was done using the t-test, and we found that for 21 days event there was no significant impact on a statistically significant impact on all the indices, whereas for 11 days there was no statistically significant impact on any of the indices when the lockdown 1 was taken as an event. I am moving on to conclusion now. So these studies, depending upon the announcements of or the rise of the cause of outbreak of pandemic, the first death and the lockdown announcement, being tested for the presence of semi-strong form of market efficiency, implies that Indian stock markets had reacted to some extent. Some sectors, especially the realty sector and the automobile sector, have reacted to this public information. It was also found that the realty sector was facing a lot of delays in projects, and looking into these negative effects into the realty sector, the government policies and decisions are a burning issue for which something needs to be done. With respect to all the industries facing a prolonged shutdown on account of nationwide lockdown, the demand for automobile sector has slowed down, and the supply chain, all these conditions need to be reviewed, and special policies and measures needed to be taken in this perspective. There is also a further need to study on the impact of lockdown 2 and lockdown 3 to confirm upon whether in reality these industrial sectors have been impacted. If yes, which has been impacted most negatively, and what measures need to be taken to get away from these losses. That's it from my end. Thank you
Thank
for
you
the
very much.
opportunity.
My pleasure. Thank you, Dr. Rawat, for the presentation. We now move on to the next paper, which is on the payback policy and stock market performance in Indian corporate sector, a tribunal data approach by Ms. E. Umarani, Dr. M. Subramaniam, and Dr. Chintal Balaji from the KL Education Foundation, KL University. I will
Hello,
request him to start the
hello, sir.
presentation.
Hello, sir. Are you audible?
Yes,
Hello?
you are audible.
Hello?
You are
Hello,
audible.
sir.
Kindly start your presentation.
Oh, okay, sir. Okay, sir. Okay, sir. Thank you,
Please
sir.
switch on your video and request Dr. Subramaniam also. I did rename him because he had come in with a different name.
Okay, sir.
Yes, we're going to start.
Oh, okay, sir. PPT presentation. Sir, is it visible to you?
Yes, it is visible.
Hello?
Please go ahead. Please
Yes.
go ahead.
Yeah. Okay, sir. Myself is Umarani, and Dr. N. Subramaniam and Dr. C.H. Chintal Balaji is the co-authors, and we are from KL University. KL University, sir. Actually, my paper is related to here the payback policies and the stock price performance in Indian corporate sector a tribunal study, sir. So thank you for providing for this opportunity for, and all the dignitaries for a good evening. Sir, it's
I will request my referees to kindly stay back. We're running about 10 minutes late because of...
Okay, sir. Actually, PPT is not moving, sir. Okay, sir. Okay, sir. Okay, sir. Actually, this paper it belongs to attempts to the explorer the possibility of links between the payback policies and the stock price behavior in Indian corporate sectors. Here, the payback policy has always been in a source of controversy, disputes, years of in a theoretical and empirical research side in the both the dividends countries and emerging economies. Actually, the papers of a futures, the panels, the data approaches of analyzing the relationships between the dividend and retentions ratio and the stock price behavior while controlling the variables of like size, long-term debt and equities ratios of the firms. So here, the purpose of here, the motivations here, where the controversy of the confusions of the overall relatives of importance of dividends and the retained earnings, the what type of earnings and what type of determinings, the price of earnings, then the ratios of in common stocks, how they are going to be the analyzing. And the mainly here, the objectives here, we are going to the discussing of the limitations of the previous of the findings and describings of the various approaches and to avoiding of those the limitations of the presence of new results and in the seems to often a more in according with the theoreticals of the preconceptions. And for example, so I have to examine of the relationships of between the payout ratio and the RAO and the domains of the QUs and the share price, the volatilities of as well as we can impact of the financial credit crisis while we are calculating onto the dividend policy or payback policy of an out of ratio. And here the identifying of the factors we can affecting of to the managers of decisions and payback of policies, and we may be the performance of the firm. And next here we are going to the next slide for the literatures of review. If you are going to the observing here, here will be the discussing of the previous papers and theoretical studies by the various of researchers and the payback policies and the performance of the factors affecting on them to the here the payback in simple form, the guidelining and principles, and the combining of the options and the dividends, the owners of retains. This type of the studies has been done, sir. And next here we are coming into here the research gaps and the total theoretical conclusions is the futures of returns and how the profitability of retained earnings is there, and here the high payout ratio and higher ratios, and empirical evidences side we go for here the dividend multipliers and how the several times we are going to the greater than to the RE, the return of earnings in the multiplier into the stock markets, and return on earnings, how they are going to be calculating by the while the using of the P by E, and how they are going to be distributing into the customers or the market sector side. Here while coming into the research gaps and the market, the valuations of on the return on earnings here, the lower on share prices of it will be effect on to the return on earnings. While coming into the methodology here, the populations here the cyclical and non-cyclicals of an industrials here I calculated here and I had the tools of populations under the chemical industries and electronical and food and steel industries I collected. And here the where the data has collected here the secondary sources of data collected using one is the accounting
Can you come to
data.
your results, please, because we have only 3 more minutes.
Okay, sir. So here the empirical results, and we have to the presenting of the first time of the results of those industries, how the applicability of fixed the efficiency models by our the previous sessions. So while I finding of the major findings in the here the usually the linear relationships of the customers, the strong dividends effects and relatively and weak retained of earnings effect in there of 5 industries. And the growth of industries and the chemical and electronical while we utilizes the more weights of relatively is given to the retained earnings than in non-growth of industries. In the growth of industries, under the weight of relatively is given to retained earnings than in our non-growth industries. For example, you have to take food and steel, the evidences. And here the holding of the firms affects the constants of dividends have a predeterminant of influences onto the stock prices. So here the short run adjustments and the prices of to the current level income and findings of the suggestors to the related of earnings received, then the greater of the relatively wide than dividends of the majority of in some such type of cases. So finally, I conclude and I giving to the summary here. The study of here the usually growth of stock markets here the chemicals industry in the week of effect of into the stock prices, the retain of earnings in the non-growth of industries investors, how they are performing of on a dividend, if the in the financial crisis in the how they are performing, how they are going to the returning and how they are paybacking of the investors, and investors perception side how they are going to be the calculating. And here the study also raised to the issue of optimal payout ratio when the different of profitability of investment of different type of opportunities is in the market, if the risk sources of financing and possibility of whether optimal payout ratio existing, so which some of to the extent of independent of the profit prospects also. So this is actually into the summary. And here the appraisals of appraisals of into here the while they are going to the analyzing of the commonly the recognitions of a models has to provide the use of an in-depth knowledge into the stock market, while they are going to be calculating of the investors investments, while calculating of an dividends and dividends policies, and the study of useful to the researcher who want to pursue through designations of any models, how they, what type of model they are going to be calculating, and what type of way of they are going to be analyzing. And similarly, it is very much useful to the earlier practitioners and academicians here into the market analysis systems. And on the other hand, here the weak points or to the major conclusions here, somewhat of the 70 chemicals companies is there, and somewhat of the optimizing of the food companies is there. These all are the appraisals of into the while calculating of on stock price behaviorals under. Sir, thank you for providing for this opportunity for IIFL, and thank you for Dr. N. Subramaniam and Balaji sir also.
Thank you very much. We will now go to the next paper. I was not able to find Dr. A.S. So I did see him before. If Mr. Rajkumar Singh is there, Rajkumar R. Singh, if you can kindly start with your presentation and ask the co-author to kindly raise his hand in case he's around. The topic is on the financial performance analysis of fruit processing firms in Manipur, Northeast India, a case study. And both the authors are from Assam University, Kachar, Assam. Yes, Dr. Yarso is here. If he can raise his hand so I can make him a host and he can start his video as well. Mr. Singh, kindly begin with your presentation.
Thank you, sir. Someone has...
You have just start with your presentation. Don't worry, it will close by itself.
Okay, sir. Thank you, sir, for giving me the time for presenting my research paper. Good evening to everyone. My name is Rajkumar Rumensana Singh, and I'm presenting the research paper, which is titled as the Financial Performance Analysis of Fruit Processing Farms in Manipur, Northeast India, a case study. Okay, just a minute, sir. So let us begin with an introduction. Whether big or small, every company needs finance to carry on its business operation. Without adequate finance, no enterprise can accelerate the expansion and growth and development of businesses. The need of finance is continuous and essential for smooth functioning and its contingencies requirement. So financial performance analysis is the process of ascertaining the firm's overall health by establishing a strategic relationship between the items of financial statements and other operative data. Okay, let us understand the purpose of the study. In spite of the fact that Manipur is gifted with suitable agro-friendly climate, the state has the potential to be the sunshine zone for the fruit processing businesses. However, industrialization in the state has been painfully slow for the last few years. This is due to the state landlocked, shortage of capital, and lack of technical and managerial skills on the parts of entrepreneurs. Being most of the farms in Manipur are small and tiny in size and operation, it is being realized that the present conditions of the farm are facing various financial problems, and even some of them have become sick and discontinued their businesses. Keeping such views in mind, an attempt has been made to measuring the overall financial performance of the farm. And here comes the objectives of the study. The main objectives of the study are to identify and analyze the overall financial performance. More specifically, the following are the objectives. Objective number 1, to assess the short-term and long-term solvency of fruit processing farms. Objective number 2, to assess the probability position of fruit processing farms. And objective number 3, to identify and analyze the financial problems faced by the fruit processing farms. Looking to the objectives of the study, the following hypothesis has been formulated. Hypothesis 1, there is no significant difference in probability among the fruit processing farms. And hypothesis 2, there is no relationship between the decrease in sales target and the lack of working capital. And that is the methodology used in the study. The study is based on both primary and secondary data. Primary data is collected from Imphal East and Imphal West of district. A set of schedules is prepared and the farms were interviewed to collect the relevant data. Secondary data relating to the study were collected from the available sources like books, journal, periodicals, official annual report, websites, etc. And population and sample size of the study. The total populations of the fruit processing farms in Manipur during the study conducted were 8 farms, which have registered with the Office of DICs in Imphal East and Imphal West district. The study selected all the 8 farms as a sample units for the present study. And this table shows that the sample farms which are operated in Manipur. And analysis of data. The financial performance is of the farm or the processing farm in Manipur is analyzed to understand the level of financial performance and the farm's problems. The financial performance is assessed by using various ratios analysis, such as current ratio, quick ratio, debt equity ratio, interest coverage ratio, gross profit ratio, and net profit ratio. The ratios are calculated for each of 8 farms for each financial year, starting from 2014-15 to 2018-19. As the period is for 5 years, 5 years simply average is calculated for each farm and compares with the appropriate standard to draw inferences. Trend analysis is also being used to track the profit figures for the last 5 years. And here are the findings of the study. Finding 1, the farm's current ratio reveals a fluctuating over the years and has unsatisfactory creditworthiness because the current ratio are below the standard mark, that is 2:1. Among the selected farms, only the farm named Sana has an ideal current ratio and the rest of the farm does not have the adequate short-term solvency, which means most of the farms are facing inadequate working capital. Finding number 2, the quick ratio of all the farms was meager during the study period. As a result, Manipur's food processing farms' overall liquidity performance is not satisfactory during the study period. Findings number 3, the debt equity ratios of all the farms are lower than the accepted ratio of 2:1. It shows that the farm's long-term financial position are satisfactory and safe for long-term lenders. Finding number 4, the study found all the farms' coverage ratio are satisfactory as they have more than the desired ratio of 2 to 7 times, which indicates that these farms are earning adequate profit to pay off its periodical interest charge. And finding number 5, the overall profitability position of the farms in terms of gross profit and net profit are satisfactory. As the profit increased over the previous year, it shows improvement in the farm's overall efficiency and profitability. Finding number 6, the study also found that 75% of the farms face problems due to the insufficient capital to meet the requirements and expansion of the business. However, they also reported they do not have any problems relating to the decrease in their sales target as their products are in high demand in the market. And here comes the conclusion of the study. As we found that the main problem faced by such farms are lack of capital, lack of financial management knowledge, and other infrastructural development in the state. To overcome such problem, the state government should conduct training and awareness program on financial management and provide financial assistance and also the loan facilities to the farm. Apart from farm-based program, the farm overall financial performance are satisfactory as its earning is increasing from year to year. This shows that the fruit processing farms are a promising one. Finally, knowledge about the marketing, financial, and management is needed to be acquired by the farms for its long-term survival. The outcome of the study will help the various stakeholders identifying the nature of the farms, and it will help in making decisions regarding investment and management. Thank you. Thank you, sir.
Yes, are you able to hear me? Hello. There is some technical which has been. We will move to the freezer. A minute, please hold on a second. There is some wipe which has been. Just give a minute. Thanks for your address. We will now move to this address. I see Professor here. Uh, able to hear? Hello.
Hello.
Yeah, Dr. Ford, I'm sorry, the technical glitch is happening because of Wi-Fi something. Are you able to hear me? Yeah, Professor, if you could kindly begin your address on research and then follow by your review points.
Sir, you are talking about me?
I would like to introduce Professor Kaur before she begins. She had with academic position. She was also the Dean Director for the High Academy of Punjab University. She is currently the full professor at the Punjab University Business School, and she is an honored editorial board member of Finance India. And very kindly agreed to review papers at very short notice and address the differences in referee rest. I would like to welcome Professor Kaur to be present here and kindly
Thank you, sir. Thank you so much.
Please go ahead.
Yeah, thank you, sir. Thank you so much. Good afternoon, everyone. Honorable Professor J.D. Agarwal, Chairman, Distinguished Professor of Finance, Indian Institute of Finance, Editor-in-Chief, Finance India. Professor Aman Agarwal, Professor of Finance, Dean and Director, Indian Institute of Finance, Executive Director, Finance India. Professor Yamini Agarwal, Director of IIF of Business School of Finance, Dean Research, Indian Institute of Finance, Associate Editor, Finance India. Guest of honor, Mr. Surinder Kathapalia. Keynote speaker, Professor Dr. Zeki Yok Cho So, and other panel member, Dr. S.P. Sharma, Dr. Jaspal Singh, Manoj Agarwal ji, Sardar, there is a Dr. Sadar Abdul Rashid, and there are other dignitaries. And sir, first of all, I want to thank you for providing me this opportunity to become part and parcel of this international research conference, and which is very, very relevant and important, and given the platform to the different researcher to share their like contribution for the specifically on finance and accounting. I would like to say a few words on my own contribution. I want to tell the all the audience, like I'm working as a professor, University Business School, Punjab University, Chandigarh, and also Director Center for IAS and other competitive exam, Punjab University. And I'm also associated to this institute as an editor member. I have also contributed to the society for the research work by supervising more than 26 students who have already completed their PhD, and 8 they are doing the PhD. But I want to tell you my area of research and a few things which should be taken care of before I'll give particularly or specifically for each individual to whom I have evaluated. In general, my area of research is finance and accounting, management, general management, strategic cost management, corporate governance, and insurance management. Actually, I have published a paper. I'm not going to detail. I have published paper on in Paradigm, more than 5 paper in Finance India, especially very close to my heart, cost of capital, value of firm, and other relationship with the financial variables. And also Vikalpa, I have published the paper. And also in Vision, I have published the paper on current in 2019, 4 paper. One was on basically strategic investment decision on the value of firm effect, and then one which is very, very relevant, impact of CEO overconfidence on firm performance, and also impact of corporate governance on stock market liquidity. And one more thing which I want to share, strategic cost management. I have also, like you can say, published paper in the season I am Calcutta, cost of quality, target costing, and even like you can say there is a activity based costing, and along with this there are very like you can say renowned paper which was actually published, family performance in business and financial performance by using the, I will share with you in Vikalpa. And one more paper is in pipeline, and there are other like you can say paper which I have already published in different journals, but I'll not more than 70 research paper I have actually published, and presented a paper in national and international conference, even a world conference. But I just want to, sir, share one or two my own observation before I'll start specifically. For the young researcher, which is actually sometimes this is missing when they are actually specifically talking about the particular topic, and there are few requirements which have to be like you can say fulfilled by those researcher, that is related to the research design, which is very relevant and important. They are not actually giving the detail of how they have selected them. It's not applicable to anybody or everybody, but overall basically the method which has to be defined clearly, and they should learn the current software and the current tools of analysis which can give the like you can say more sophistication in the finance area. For example, I'll tell you the latest method which I have used in my own research work, state space model. I find it very difficulty when I was want to convert it into reality. I took this assistance from UK, one of the professor, but definitely if when once we learn, definitely those can be used. And I'll talk about like you can say maybe more sophisticated tools, the simultaneous equation, panel data analysis, structural equation. I'm going to present one paper on 28th, and definitely I'm using structural equation model for that, and I'll give you the analysis. And one more thing which I want to, when they are selecting the variable does not only mean the statistical relevance, that has to be defined. The financial data has to be, the variable should explain the relationship in terms of like you can say what is the relationship of financial variable one with other variable. And definitely like you can say findings even not given by the researcher, sometimes they are not able to elaborate and give in detail in a systematic manner which is actually required. And some of the researchers, they are using the regression without testing, without cross-checking the assumption, which is not actually representative. Sometimes they are using the tools of analysis, same tools of analysis, but does not have the relevance to use that the same. So I just wanted to tell the researcher, young researcher, specifically learn the current software. Amos can be the latest math, any number of like you can say software. R is there, Amos is there, where we can in finance specifically when I'm using the either the primary or the secondary sources. So I should have the organized like you can say variable organized explanation. And I'll tell you, nobody actually gave us the future directions, and even I'll implication of your study, which is very relevant, can be like you can say can be described in detail and presented in any particular study. This is my actually observation, which should be used by the young researcher when they are doing that. This is my humble submission to the young researcher. Please focus on the quality research rather than the quantity, because if you will, one quality research paper will give the contribute to the society, to the corporate world, and to the academician and the future researcher who will use your information, your data, your findings, and like you can say in near future the n number of that will cater to the stakeholder. Now I am coming back to my the review of paper which I have reviewed. I'll give you observation within 5 minutes, one by one. My first paper which I have reviewed, that is paper code 2307, and topic was payback policy and stock price performance in Indian corporate sector, a tribunal data approach. You know, under this particular study, a researcher definitely tried to create the link between the payback policy and stock valuation behavior, which is prevailing in the corporate sector. According to my observation, sample size was very good and sufficient. Tools of analysis which is used by them, that is again good, but there are like you can say definitely the variables which is used by them, it was not clearly actually defined, which is according to the requirement. What is actually like you can say required to be completed in this paper, one is the review of literature is available to us but insufficient, even not defined in a good manner, and latest studies are not available to us in this particular paper. This is first my observation. Researcher design can be presented in a more organized manner, so that should give the clarity. And then findings of the study, like you can, it should not be like you can say in a detailed manner, but it should be concise and completeness has to be there. So that is I will suggest if more concise and comprehensive findings can be defined by the researcher, and implications were not there, future direction of the study was not there. One of the very relevant something which is left out, although use the regression analysis, assumptions of the tools of analysis was not cross-checked. It was not mentioned in the research paper, without which we are not able to find out whether my study is representative or not. And definitely and a number of stakeholder can stake, even the financial manager and investor, other stakeholder can use this study for taking the different decision. Second paper, which was actually related to code number 2306. The topic was FCFF valuation in Indian FMCG sector, empirical evidence of top 10 firms. Definitely, a researcher want to actually find out the how the value of firm can be determined, and based on free cash flow, and he's talking about the methods, different method which can be identified through which, like you can say, even the different financial variables which can be identified for the different sectors, and like you can say, and which is the particular industry which cater to our requirements, so that like you can say this well, if good value of the firm of a particular industry, it's good for the stakeholder. And definitely this is helpful for this study gave us for this particular this contribution. But my observation for improvement, again sir, review of literature is not sufficient, please, not comprehensive, even the latest studies are not there. And then research design, I'm not happy with the way they have actually organized. Even the findings more organized, and even like you can say comprehensive findings can be there. Again here the implication and the future researchers future directions for the study is not mentioned by the researcher. Definitely for taking, the financial manager can use this, even the other stakeholder can use this particular study. And the last which I have reviewed, financial performance analysis of fruit processing firm. This is a particular case study. In this particular study, actually researcher evaluated the financial performance by taking into consideration the short-term solvency and the long-term solvency of the concern. He was talking about liquidity, profitability, and the financial problem which can be faced by the fruit processing firm. What was the observation of the study? That short-term position of the study was short-term position of the firms as far as the working capital conditions, that was not good. but the profitability of that concern or the long-term solvency is good. This is my question. If short-term position is not good, how the long-term solvency is good? This is my query. I don't know how they have actually able to. And what are other observation? Again, sir, review of literature is, and one compliment for this study is period of the study is bilkul naya, current, that is 1415 to 1819. Research design can be more organized, even the findings of the study more a course, sir, which is very, very relevant, definitely finding given by the researcher. The more sophisticated tools, you know, ratios are available to us. Further, we have to experiment something so that can give us the unique contribution for the study. So please, this is my humble submission and observation for this. If we can use more one or two tool for making more like you can say good contribution, so that is more sophisticated tool can be used by the researcher for, like you can say that a unique contribution, further representative. Definitely this study can be used by the financial manager, even to choose by other stakeholder to choose the best company or to tell the financial health position of the concern. Overall, sir, my observation is definitely all these researcher contributed something to the stock of information and to the society, to the like knowledge of stock of information. Definitely, according to my perception, these three paper can be accepted, but with the few certain revisions. And I want like you can say I want this from the younger generation, younger researcher, please focus on the quality research and learn more more sophisticated tools, sources, sample, and even the tools of analysis, which is the need of the hour. And I want to thank you, sir, specifically for providing me this opportunity, and I want and feel honored and special thanks to convey my thanks through Professor J.D. Agarwal, sir, and to all the dignitaries. And thank you very much for providing this opportunity. Thank you so much.
Thank you very much, Professor Kaur. It's a pleasure. And I think you pointed out very important points, which most of them are missing. I have seen actually all the papers in a graphs, and what you pointed out are really the points which I was happy that you pointed some of them out, because it's important that we give a candid view to all of them so that they can get a better perspective of what they want to do. Definitely. And how do they improve it. Because, you know, you can always keep appreciating. Appreciation is important, but to a limitation. And I think that's where it's important. I would now, I think Dr. S.P. Sharma has not joined so far, so I'll move to the next my referee. Dr. Kaur, please do stay back for some more time.
Definitely, I'll be there, sir.
Yeah,
no problem.
I think Dr. Jaspal has also not joined. If he's joined, kindly open your video. I'll just check with them. In any case, I will request Mr. Manoj Agarwal, who has joined with us. He's already there. And that's why you see, because Dr. Kaur was also mentioning about the practicality and the practical application. So we have two people today who referee, and that's what I do. I bring in people who have academic background. I see Dr. Jaspal, who has joined us. So we'll go to Manoj, if you don't mind, if I can take a minute more off, and then we'll go to Professor Jaspal because he was in the meeting committees and all. So I requested him to still come forth. I would request him to kindly, I'll just make you just a second. I'll just make you the, I could not, because your name has come as a number, so we could not identify you. I see him here. Please unmute yourself. Jaspal Singh is professor of Guru Nanak Dev University, and we've known each other. And first time we met when he invited me to do an external vivoce of one of his doctoral students. It was such a pleasure. SP is also joined. SP will have to wait for 2 minutes now. We'll have to go to Professor Jaspal Singh, who will present his first comments on what does he feel on research and what are important. And since he has been here, I know this number has been there for quite some time, so he's seen some of the papers. What does he feel about it? and what should people go about doing, and then present his view on the papers which he had reviewed. Please. Over to you, Professor Singh.
Thank you, Dr. Aman. Am I audible, please?
You're very much audible.
Okay, sir. Thank you so much. All the dignitaries, my fellow panel members, the participants, and the presenters. A very good evening to all of you. Dr. Aman was referring that he visited our place a way back, and that's the reference we have. But before that, I would like to remind that respected Dr. J.D. Agarwal has been one of the evaluators of my thesis when I did my PhD, and he was one of the panel evaluators who actually
Sir took my Viva, PhD Viva. Professor J.D. Agarwal sir took my Viva.
Okay. Nice to be together this time. At the outset, because 3 papers were given to me, and I am really thankful to make me part of this endeavor. 3 papers I had. At the outset, for all the authors, I would like to make certain recommendations. First of all, I appreciate effort done by all the authors. And just remember one thing, that is there is always a room for learning. So we should keep this thing in mind, that if it's a research, it's ever going concept, and there is always a room for learning. Secondly, my suggestion to all of you is to build your research problem on a sound literature base. That's what Dr. Paramjit is also referring, that the literature part is a little weaker. So whenever we build a problem, that should be on a sound literature base, because only then you will be adding something to the literature field in that area. Thirdly, I would like to say, always connect the end result of your research work. In short, in papers, generally we find the implication part, that's what we write over there. So whatever is the outcome of your research, try to connect it with the problem when you started. Where it's going to be relevant, that connection should not be lost, it should always be there. And finally, I say, don't ignore the assumption of the technique or the model you are using, because they are the most important thing. Generally, that's where we generally check the goodness of fit, if I say, the technique, whether it's applicable or not, but we are using it to add ornamental value to the paper. That we generally, it's a mistake generally, that's what I say we do. That assumption, that whatever the model we are using, the assumptions are given. So first we try to sort out those assumptions. If it's done, then only we use that particular technique. Now regarding the papers, if I take one by one, the first was nexus between tax buoyancy and economic growth, evidence from India. This paper was by Dr. B. Suresha, T. Ravi Kumar and Rajesh from Christ University, Bangalore. I could not attend actually the presentations as Dr. Raman referred it. Some processes are going in our university right these days. We are into the process of admissions also. So I couldn't attend, but I could read the papers. So important highlights what I can refer here. When I say taxes, we all know that taxes are their major source of revenue for the government, direct and indirect both. That's the exchequer where they are added and from where the government is going to do spending. Now, in Indian context, if I say, the past data shows that direct taxes response to growth and economic activity have not shown equivalent growth. The tax revenue collected from direct sources, if I say the direct taxes, they are not in consensus with the GDP growth that we have seen. Now here, the purpose of this study conducted by the authors, they were talking of tax buoyancy. And tax buoyancy is the responsiveness of tax rate growth in comparison to GDP growth. That was they were trying to work out. And obviously, that if GDP is growing, that means earning of the people in the economy is growing, so that they have a better and more capacity to pay the taxes. That's the general premise we have. So they tried to find it through this study. Data collected was obviously it's a secondary data they had from published government reports. They took the data. Time period is 2001 to 2017-18. And the methodology they use is linear regression model for the purpose of working it out. Results they had that the findings do not support the proposition of increase in GDP that leads to better tax revenue to the government. So ultimately they also found it out it's not so. Because for a policymaker, for the focus of the government is always to make it double figure and to go higher and higher. But regarding tax collection from direct tax sources, if I say, it's not in consensus with the growth. So this study also, they proved it, it's not so. So much of work is already done on this also. And the focus of the policymakers, so it should be, because they have been trying their level best. So much of procedural and other reforms are in place. Like if I say simplified tax rates, they are there. Self-assessment schemes, they are there. Automation of assessment is there. E-filing is there. Quick refunds, assesses interface systems. So much is at place. Still, they could not entice a better response from the taxpayers. So in such a case, chain in the slab and tax rate cuts encourage people to earn, save and invest. GDP growth shall result in the growth in the tax collection also, commensurate with each other. So the taxpayer suppress the actual income usually. That's where the problem lies. And they have calculated R-square, that's coefficient of determination, it's very low. When I say they are basing the tax revenue collection as dependent on GDP growth in India, that's independent factor. Now the relationship between the two is only 0.02 they could find out. That means there is still a room for improvement to find out the 0.8 part of it. So if we can work out different factors, different reasons for it, and we can improve and we can suggest to the policy makers that how to proceed, that would be a much valuable research work. Second paper was on a study of financial literacy and its impact on investment behavior during the lockdown period. This paper was by Dr. R. Anantha Lakshmi and Mrs. G. Madhur Ramadi. It's from Salem, Tamil Nadu, Sona College. Now, obviously, we all understand this COVID-19 era have caused dynamic changes in our socio-economic scenario in India, if I say, and for the world also. Employment has been lost, incomes have been negatively affected, future seems uncertain. And the word of advice that is pouring in is to learn to live with the COVID currently. So we cannot identify that how much it's going to be prolonged still. Vaccines are into the formation, they test them, then they withdraw it, it's not working properly. So we cannot work out how much time it's still going to take. And we have to bear with this current economic scene in the country now. People are preferring to safeguard their savings and simultaneously looking for different ways to make their wealth grow for the rainy days. That's the current scene. With this background, the authors, they try to work out the financial literacy impact on investment behavior during these times. The data, it was only a small data of 60 respondents selected through simple random sampling method from the Salem district in Tamil Nadu. Methodology, it's a simple state, they use descriptive stats only. Nothing bad in it, if you ask me personally, obviously, because we are trying to pinpoint a situation there. So it could be any way. If we can do it, we can justify it in a right way, then obviously, no doubt, techniques, they are more quantitatively, they are more sound. And obviously they add if I say the ornamental values. But obviously we are looking for the objective. The findings they had is, there is a significant difference is found between respondents' level of financial literacy and their awareness on investment options. Now, this peculiar finding, what they found is that those who are, if I say, the highly informed or high level of literacy they had, they prefer to invest in risky assets. That's the finding of their study. Like equity and preference share, they are there. Mutual funds, they are there. And insurance policies, equity-linked insurance plans, they prefer to invest in these risky assets. Those who have high level of literacy. Second finding they had was with the moderate literacy levels, they prefer midway like FDRs. That's what their finding is. And with low level of financial literacy, the investment is more preferred in post-office schemes and alike. Also, majority of the people, what they found, they had emergency funds during their times of COVID. It's a good news if I say the people do save, and it's with every one of us that whatever we earn today, we don't try to spend the whole of it. So we prefer to have some backup for it. Backup plans, they are there with them, anybody, whether financially literate or illiterate. So normally everybody is saving. So majority said that they had emergency fund during this time of need. Now, obviously, to my mind, if I say the financial literacy, that's more of application of a skill to build social financial stability for oneself. But before that, more important is the financial education. So if it would better be related with that part, and then we go to the financial literacy level, that how much of that total education has resulted in financial literacy. That could be a little lead for us that how our education system should be planned, financial education specifically. Then third paper interested to me was on examining asset pricing models in Indian stock market. And this was by Dr. S. Durga and Dr. P. Venkataraman Rao, KL University, Andhra Pradesh. When I say because this theory runs back to 1960s and mid 60s, if I say 65, Sharp was there, Mossini was there. So 3-4 people, they actually worked on it. And since then it's working because our focus will be, because it's hard-earned money, and what we save, we cannot keep the funds idle. We need to invest it somewhere so that at least inflation could not eat up the value of the capital. That's always the basic premise we have. Now, asset pricing basically helps us, that's the name itself suggests that model for pricing the asset, capital asset, how we can best do it. Capital asset pricing, when I say this model was based on single model, as we all know, it was based on just one independent variable, that was market return. Then FEMA and French, they made it a 3-factor model by adding 2 factors to it. That was, one was size, other was value. Because the predictor, if I say the market returns, they were not the sole predictor of return on an asset. So there was a gap, and that gap, what we name as alpha or intercept, that alpha, now they try to segregate that further. They developed 2 another factors to it, that was size and value they added. This paper, they have tried to evaluate CAPM, that's capital asset pricing model, and FEMA French model, 3-factor model.
Sir, 5-factor model आ चुका है अभी.
Yeah, मैं बता रहा हूँ. Just for a while. After this, one more momentum was added by Carhart. That he made it a 4-factor model. Now FEMA and French, they are working on 5-factor model, as madam is also saying. It's in a testing stage, if I say rather. Now purpose is to closely predict the market return or return we are expecting from our investments. Now in this case, within this study, what they have done, the focus is on checking the, if I say, as they suggested, examining asset pricing model Indian stock market. The focus on R square. Now, how much these independent factors can predict the dependent factor, that's our required rate of return or return from our asset, they are focusing on that part. More so, if I say the focus, if they'll shift a little now, because largely alpha is also being reported now. So this scenario is taking a little turn now towards performance valuation. Because alpha, when we mark, that is what we say in finance theory, that's a fund manager's performance. That's other than the factors which are describing the dependent factor, what else added to the returns? That was alpha, that's why we say it is performance of the fund manager. Now, if we can, now obviously still work is going on because we have to still check how much R-square they get by adding this fifth factor. And still we will find that it will not be one, still there will be some room for the improvement. Because it's obviously markets are inefficient, that has been proved in the literature also. So there is always a room for improvement. Now they're working on the fifth factor. Maybe tomorrow you find it gets one more factor is being added or another factor is required. So in this part, my suggestion will be let's focus it on the performance valuation part, taking alpha into consideration, rather just sticking to R-square part. Thank you very much.
Yeah, thank you, Professor Singh. We will now go to with Dr. SP Sharma. Manoj, I'll have to excuse again because Professor Sharma has a very specific condition. He has one family member who is actually a very close family member who has actually been in the grift of corona, and he is actually.
Yes, sorry to hear that, sir.
So
sorry to hear that.
But he still agreed to come. You know, he is a very professional man, being in the industry. He knows how industrialists pull him left and right, being the chief economist. I leave it now to Professor Sharma. Kindly, if you can just open your audio, talk about what does really research mean for you, and especially when academic research comes to you from an industry perspective, how do you see it and how does it work? And then maybe give your review comments on the papers as well. Please go ahead, Dr. Sharma. Please unmute yourself, sir. Yeah, perfect. Go ahead, Sharma. Yes, please.
Thank you, Professor Agarwal. Firstly, at the outset, I must congratulate Indian Institute of Finance for organizing such a beautiful conference with the various research papers, and I believe these research papers are going to benefit the economy and the businesses to move forward and to come out from this daunting impact of coronavirus on the Indian economy. Professor J.D. Agarwal ji, Professor Aman Agarwal ji, Professor Yamini Agarwal, very good evening to all of you and the esteemed panelists and the participants, researchers in this very, very dynamic conference. Firstly, I would like to mention the practical aspects of this research that I was going through the 3 research papers, and 3 are very, very dynamic and important for the policy making and for the benefit of businesses to move forward and to come out with various implementation programs at the ground level. So I'll start from the first paper, which is on an analysis of virtual world of education during COVID-19 with respect to Management Institute of Mumbai. They have analyzed the impact of the virtual programs of education. The objective of this paper was to identify the problems faced by the academicians in the virtual world of education during COVID-19 period. Factor analysis was used to assign weights to each variable and extract 5 factors. The study found that though virtual teaching has its own drawbacks, but there is a positive side also, that is enhancing the digital knowledge of the people. This pandemic period has made young as well as aged faculty to sit in front of laptop, computer, mobile, iPad, and learn to use them in each and every aspect, because all the escape routes are closed. So this is very interesting research paper conducted by the researchers, dynamic researchers. I must appreciate the selection of this topic. They have used a very simple research methodology. The study was descriptive in nature and survey method was used to complete this study. The population of study comprised specifically of the Faculty of Management Institute in Mumbai, and there are around 120 management institutes in Mumbai, and convenient sampling technique was adopted with the 100 samples. And a study has come out with the dark side of the virtual world. The second most important determinant factor are they don't reply when faculty ask question, and classroom problem student mute sometime. For test using alternatives, they use alternatives, and they log in just namesake. These were the significant outcomes of the study, and they are also exploring the new waves of cheating rather than exploring the books. Good students are getting less marks than the backbenchers. So the study has come out with very interesting findings, and study has concluded that pandemic crisis has upset objective of access, equality, excellence in the education sector, and has made online teaching and evaluation as new normal in this creating and digital world. The call for de facto switch over to virtual teaching, learning and evaluation pushed a huge number of teaching faculties into an unfamiliar mode. The massive shift to online mode will be tantamount to make 1/3 of teaching faculty redundant, which may be adopted for cut in public expenditure. So, but there are a lot of limitations of this study, because this study has been conducted in the city of Mumbai only, and I believe that too in the Management Institute, and because there are a lot of diversification in the Management Institutes also. Some institutes are providing the practical aspects, and some institutes are providing the theoretical aspects, and management institutes are entirely different from the other coursework institutes, like like university education and past courses in the other graduation and post-graduation courses. So my suggestion is,
can you request her, because I'm not able to speak with her, can you please ask her if you can join the Zoom meeting in about half an hour from now? In half an hour from now. Another half an hour. Yeah, yes. Yes, she confirmed to me about a week back, then I sent her the details also. Sure, if you can just let, because I was trying to reach her.
Professor Aman?
I'm very much ESP. Please go ahead.
Yeah. Shall I continue?
Please go ahead.
Okay. Thank you. So my suggestion is that there must be a wider sample across the states to find some solutions, and to recommend something to the government for the virtual education, and to make it more and more dynamic, because we can't only concentrate on Management Institute. We have to study all the dynamics of virtual education, starting from school education, then the college, then university, and the management institutes. And we should also focus on the technical institutes also, like IITs and other related institutes with the technology. So going forward, I believe this study has implications for the education system to become more and more efficient, and to contribute more in the skill development and knowledge economy. So my next paper of review was Nexus between tax buoyancy and economic growth, evidence from India. This is also again a very interesting paper, and the researchers have analyzed the relationship between the growth of the direct taxes and indirect taxes, and the implications for the revenue segment of the economy, whether the higher tax collections are beneficial for the economy, for the GDP numbers, for the fiscal deficit or not. So then again, the findings are very, very interesting, and I believe this will help the government to focus more on the policy aspect, because the study has come out with the findings of long-run relationship between GDP growth rate and revenue growth in India. And last 2 decades, India has experienced uneven growth in the revenue with convergence of percentage contribution of direct taxes to the aggregate revenue within direct taxes. So direct tax buoyancy is deteriorating in recent years, and there is favorable improvement in the indirect tax buoyancy rate. Here again, I have a few suggestions that study must consider the international best practices, because GST was implemented in 2017 only. So we can't provide any policy direction at this juncture whether the tax collections, indirect tax collections are beneficial for the growth of GDP or not. We have to study the international scenario, also the best practices of the global economies, because I was going through some statistics of the countries in advanced world and emerging and developing economies, and there is a very interesting finding that where there is a low tax slab, the tax to GDP ratio is also high, because tax evasion becomes not that much beneficial for the evaders when the tax slabs are lower and they pay more taxes. So where there are the tax slabs in the lower trajectory, the tax to GDP ratios are high. But unfortunately, in India, the tax slabs are very, very high. GST rate, the higher tax slab is at 28%, and then 18% and 12%, 5%. So there are a lot of tax slabs also, which are confusing sometimes to pay the taxes for the taxpayers. So my suggestion is that tax slabs must be lesser, and tax slabs should not be that much high, and there should be more and more simplicity in paying the taxes. So then the tax to GDP numbers become higher if the tax rates are lower, and the tax evasion is also not that much beneficial for the tax evader. So this study has provided interesting findings, and I suggest that this must be enhanced to the level of some study of the global economies. They can consider the countries from the advanced economies, 2-3 countries from the advanced economies, then 2-3 from the emerging and developing economies, and 2-3 countries from the smaller economies, lower income economies, lower GDP economies, and some economies from the Middle East countries. So that will be a combination of whole sample of the dynamics of the world economic system, and provide a good shape how the taxes are beneficial to to enhance the GDP numbers. So I appreciate the selection of this topic by the researchers, and I believe if this study is enhanced to the level of international best practices, then this has very, very dynamic implications for the policymakers in Government of India. And then there is a research paper on outward FDI, macroeconomic determinants of home country. This is also an interesting paper, and this has provided that outward FDI is inevitable in process of economic evolution and globalization. Low and middle income countries need to emphasize on improving their political governance to prevent capital outflow arising out of high domestic political risk. On the flip side, investments in research and technology contribute to the growth of outward FDI, thereby yielding mutual benefits of internationalization in the long run. Given the evolving role of low and middle income economies in the global economic scenario, stability between local and international investment is crucial for harnessing the benefit of globalization achieved through proper governance and policy reforms in specific fields. So this study also has very, very dynamic implications for the outward and inward FDI scenario, because Government of India is doing a lot in the ease of doing business. So at this juncture, I suggest that the researcher should also consider the ease of doing business parameter of the home country, because now ease of doing business is becoming a major driver of attracting the investments. I think that part is missing in this study, and we must study the ease of doing business level of that particular home country, whether the country is in the improved trajectory of ease of doing business, or the ease of doing business is decelerating in that particular home country. So that will provide the more insights and more policy implications, and some suggestions for the implementation for the government. So this is an interesting paper, and I suggest that this paper should be widened to consider the concept of ease of doing business in the parameters selected to study, which are the conventional parameters like the macroeconomic parameters of home country. So going forward, these three study papers are very, very important and very topical also for the current economic environment, because COVID has impacted the whole world economic scenario, and the world economy is not in the good shape. The GDP numbers are decelerating. We posted 24% negative growth in the last quarter, and we were the worst economy in the global ecosystem. Though we were the fastest moving economy in 2014, 15, 16, then economy become in the slower mode because of the trade war between the US and China, and structural and cyclical problems in the Indian economy at the domestic front. Now, with the daunting impact of COVID-19, now the economy has been significantly decelerated to the level of 24%. But the good thing is that our agriculture sector is doing good, and that is the low-hanging fruit at this juncture, which has posted a good growth and positive growth of somewhere between 3 to 4% in the last quarter. And good news is also from the export side that agriculture and agro exports grew by 23.4% in the first quarter of the current financial year. So going forward, I believe the FDI and the ease of doing business in the food processing sector will help the economy to rejuvenate from this deceleration, and this will become the major growth driver going forward to push the economic trajectory to the higher level and to become more and more visible in the global charts and to contribute more in the global economy. With these words, I thank you, IIF, for organizing this very wonderful conference, and I look forward by more and more participation in such kind of research or seminars, webinars. I thank the IIF, Indian Institute of Finance, and Professor J.D. Agarwal ji for inviting me for my viewpoint, Professor Aman Agarwal, and I congratulate Professor Yamini Agarwal for such dynamic conferences, one after one in the difficult time of COVID-19. Thank you very much.
Thank you, SP. It's great. Let me tell everybody for who is here, SP has developed the whole chamber. The PhD chamber is over 100 years old. It was Punjab, Haryana, and Delhi chamber earlier. Now it's Peace, Harmony, and all. But the thing is that I was also on the managing committee for some time when SP joined about 15 years back. But SP has brought the research part to the chamber. He has rejuvenated and he's brought large number of government projects, research projects to the chamber. A huge chunk of money earned for the chamber by SP, and he's developed the full wing. He has now a full floor as against only one room which chief economists used to have in the chamber. That is where, and you know, as a matter of fact, in all our reviews, we have about 6 reviewers in every paper in a regular issue, about 4 to 5 reviewers in a conference-based paper. One of them is always a practical person who has a doctorate beforehand, mostly. And that's where we want to bring in a person with 40, 50 years of experience of dealing with research or practical aspects of that particular area to also throw their light on what do they see of the research. And that's where SP comes in, Manoj comes in, and even Sadar comes in. So I thought I will now move to Manoj. I see Professor Kishore. Kishore has joined in from the US. It's an early morning hour. Thank you for joining in. I'm trying to reach Ramona. She's the rector of a university. She's actually been from one place to the other. She's gone to another campus of the university. So I was trying to connect with her and I got disconnected in between for a few minutes. I'll now go to Manoj. Manoj is the group editor for Banking Frontiers. It's a magazine which has been coming out for almost 20 years now. It's a leading magazine in banking sphere. They mentor large number of cooperative banks, other banks, and they started an event called Finovity and Technovity, which is a motivator in terms of giving awards and recognition to innovations in the banking front, and I've been on their board for last 10, 12 years. An idea which Manoj discussed with me for almost 2 years, and finally they got it into rolling around 2010, if I remember correctly, if my memory is not failing. So I brought in Manoj again. Manoj has always been a supporter like rest of you. Manoj, I would like you to give your point of view on research. What do you see? How do you see it in banking? And then your views on the papers I had sent to you.
Sure. Thank you. Thank you, Professor Aman, very much. It's really privileged to be a part of this discussion and forum. Am I audible clearly?
Very, very audible. Please go ahead.
That's great. Thank you. Special regards to Professor J.D. Agarwal, and a warm welcome to all researchers and referees into this forum. I'm from the media side. I run a magazine called Banking Frontiers since 2002. And recently we've started adding videos also to that. And we've started doing a lot of international coverage as well because of the digital media. So knowledge has been always the focus area for Banking Frontiers. But around 8 or 10 years ago, we realized that more than knowledge, the financial sector is now looking at innovating at a very fast pace. And that's how this idea of Finovity and Technovity emerged, to recognize the innovation and to publicize it as well. And the last 4-5 months, this innovation has actually taken off at a rocket speed because of the COVID crisis. Banks no longer have, banks or in fact entire financial sector no longer has any ready reference how to deal with the crisis that suddenly landed upon them. So everyone simply just use their the creativity, their innovation. A lot of brainstorming happened. A lot of risk taking happened. Decisions that would take months were done in days, is what several people have told me. And the board and the management has agreed to those recommendations by the CIOs or CFOs or marketing heads or HR heads, whatever it is. So this crisis, one thing it has shown is that we need both the left brain and the right brain, the left brain representing knowledge, the right brain representing innovation, to come together. It cannot be on half the brain that the organization or the industry can run. So one recommendation I have upfront for all the researchers, please focus on innovation, how the organizations and how the whatever topic you're studying, look at it from the innovation perspective. I think you'll find it very, very interesting for yourself. I also think that your readers will find it very interesting to see what kind of innovations are happening. We all know that all innovations don't succeed. Maybe 80% of the innovations actually fail. So in fact, the industry has prepared itself by conducting proof of concepts to make sure that before they roll out anything on a large scale, they increasingly rely on proof of concept with some fintech partner or whatever partner they choose to test it. More so, even the regulators are now looking at innovation. So regulators have come up with this sandbox concept, where participants, organizations, anyone who's involved in the industry or even a startup can come and try out their innovation. And if it succeeds, if it meets all the compliance norms, if it handles all the risk issues, then they give it the go-ahead. So I think this interaction between research and innovation has to happen. And India is frankly in a good place. We have the talent for both. We have a lot of people in research. We have a lot of people doing innovation. If these two group of people come together, I think they can do wonders. So that is my overview on this whole thing. Let me now come down to the papers that I have reviewed. The first one I have is Eminence of Urban Cooperative Banks, paper number 2325. This paper has focused largely on the financial aspects of cooperative banks and has some interesting findings. For me, it was interesting that cooperative bank branches in tier 2 cities were doing much bigger business than those in tier 1 cities. And B-class cooperative banks were much larger in size overall compared to the A-class banks. So that's a positive as well as a negative. one thing we have learned about in our own interaction with the cooperative banking sector is that it is a service-oriented sector. It is not really a financial sector. Financial is, if you look at the cooperative sector overall, it is not really a hardcore sector. It is serving as a bridge between the producer and the consumer, whether it's a dairy sector or a fisheries sector or financial sector. And so it is much more customer oriented. Of course, there have been in the financial sector a lot of frauds and all that. But because it is not run like a business, it is often not very profitable. And because it is not very profitable and growth driven, it is not trying to become a country leader or a world leader in anything. It is only trying to serve its community that it is targeted. Its financials may not be really reflecting what its agenda is. So financials are important, no doubt about it, but not as it is for a commercial organization or a commercial bank. So for the researchers, this perspective must be kept in mind. The cooperative banking sector has actually lagged behind your regular commercial banks, public sector and private sector banks in terms of technology adoption, because they always had a very narrow focus. I'm serving my customer. If I know my customer and my customer knows me, why do I need so much technology? But in that process, they've lost a lot of customers, especially the youngsters. And now they're trying to do catch up. Okay. So that is one aspect of cooperative banks that deserves much more research focus. So if there is an opportunity for this researcher to go ahead and extend the research, technology one area I would recommend for them to study. Another point that the researchers missed is that there have been a large number of cooperative banks that have actually closed down. And many of them have actually been merged with some other cooperative banks. So that affects numbers in a sense overall. So that is also worth studying. What is missing in the analysis is the explanation of whatever has happened, why that has happened. And that explanation cannot come just by doing a mathematical analysis or a statistical analysis. The cooperative banking sector is deeply influenced by external parameters like economy, politics, or any other business development. Okay, so in that sense, it's a fragile baby that is in an ecosystem, and the ecosystem impacts the baby a lot. So that external impacts have to be studied, whereas the financial figures will only tell you the result of that impact, whether the bank made a loss or its NPA went up or whatever. For example, if there is a lot of flooding in an area that the bank has lent to, then obviously the borrowers are not going to be able to repay their loans in timely. So these kind of factors need to be analyzed. For a State Bank of India, what would happen is it would average out a lot. Flood in one area, earthquake in some area, some change in some area. For an SBI balance is that. But for a local cooperative bank, if there is an impact, it's a big impact. So the good thing about cooperative banks even today is that they remain at the forefront of financial inclusion in their own limited space, because they are very much approachable. They speak the local language. The employees there are local people. The employees there already know the people in the community. So the initiation of a customer into the financial ecosystem becomes much easier. Of course, they don't have the breadth and depth to carry on and service in that. So that context needs to be kept in mind, that they onboard customers more easily, but then they should partner with insurance companies or mutual funds or other financial organizations to offer more relevant products, a broader platter of products to their community. So that would be my 3-4 suggestions to the researcher, that it's a very dynamic animal, this cooperative bank. Don't look only at the financials. You will not get good financial figures for sure, because making huge profits is not their objective. But they play a broader role in the ecosystem. Just like an NGO. You look at NGO's financials, you won't get much out of it. Same way with the cooperative, they're like a semi-NG. So that was about the cooperative banking paper. Another paper I reviewed was Virtual World of Education, paper number 2294. And I think this was covered by Dr. SP, the speaker before me also. So, and he has gone into the findings of that paper in detail. So I will skip that part. But one thing is for sure that this is such a new thing, online education, on a broader scale, that I'm sure there is very little research, or in fact, perhaps almost no research on that subject, especially for Indian perspective. So just taking it up is something worthy step, okay? The scope of the study is very narrow. It's only Management Institute, it's only within Mumbai. Within that, the researchers managed to get 100 people to respond, which is good. So I think it's okay to start small and then take further. So my previous speaker said that the scope should be wider, which I agree. But I would also recommend that the scope should be ongoing. You know, the problems that are studied in April and the problems that come in June and the problems that faced in September are going to be very different. The sector is evolving so quickly. People are adjusting, the teachers, the students, the parents, anyone. The technology in the ecosystem is adjusting. People are buying maybe better devices, upgrading from 3G to 4G, or upgrading the Wi-Fi router, whatever it is they're doing. So making one study at one timestamp study may not be very effective. What would be more effective is a series of studies, perhaps with the same set of people, spread out over 6 months to see which problems are rising and which problems are declining. So rather than saying this is the biggest problem and this is the smallest problem, it could quite happen that the smallest problem might become a bigger problem down the road, and the biggest problem could automatically get resolved because 10 people are working on that biggest problem. I'm sure the teachers who are training online are not sitting idle and waiting for government to solve the problem or waiting for technology to solve the problem. They're using again, it goes back to innovation. Indians are good at this jugaad kind of innovation. And I'm sure even as we talk, the biggest problem is getting smaller. So in that sense, it could be a self-solving problem. Could be. I'm not saying it is. So a dynamic study spread over 3 to 6 months would give a better picture which problem is rising, which problem is solving. So that then technology interventions and policy interventions and innovations can then come into the picture on a research-based platform to drive something meaningful. So this study is more from the perspective of the professors, but actually I would recommend the professors are not the consumers of education. They are the deliverers. The consumers are the students. And that student perspective is very important. And what I would recommend is divide students into 3 categories. One category of students is strong in self-study. So they are not really affected what happens to the physical college and infrastructure. As long as they have access to information and material and knowledge, they will go on. Second kind of students who are partially affected, and the third kind of students who are deeply affected. Someone in a tier 5 city who doesn't have internet access, you know, whatever the professor does, that guy is stuck. So this is one suggestion about, from the student's perspective, how education sector overall can fine-tune its delivery mechanisms so that it begins to make sense for each kind of student, the self-learner, the guided learner, and the weak learner. So this is my comment on this paper. So I've managed to study 2 papers. The third paper, unfortunately, I didn't get time. It was a kind of a longish paper with lots of numbers and tables and math. I will give my comments on that later on, maybe over the weekend.
Thank you, Manoj.
So thank you, Professor Aman. Thank you, everyone, for hearing my views. And
Manoj, do stay back. We have an expert from US who's going to speak, a dear friend again, who's going to speak another 15-20 minutes from now. I go to Sadar now for his comments and comments on the paper. Sadar has been a student of mine and has had a long experience working in the industry. He was working with MCX for quite some time, and Salim is here. I see he was the chief economist for MCX. I see I do remember Salim Andrews, who just joined, and I think he was still here. He's still here, and if he's joined, then maybe we'll see him later. But Sadar might have worked with him also at that time. Sadar worked with MCX and with groups in Saudi Arabia, Bahrain, and now he's working with the Al Ghor Group in UAE. He was also the head for trading. So he's been working on trading, risk management in the areas, and so I thought it would be a good insight for him as well to look at some of his insights of what he's looking at, how the industry is moving, how the trade is moving, and what does he see from the research which is being done by professors here. Sadar, to you.
Thank you, Aman sir. Am I audible to all?
You're very much audible.
Thank you. Thank you, Aman sir, and the IIF fraternity, JD sir and Amini madam for giving this opportunity. And good evening, all the dignitaries and the panelists. And I was really enjoying this show from the beginning, and it is really nice to be having this kind of opportunities for the young presenters as well as the researchers. And the important thing is the mix. Aman sir has kept it here, the people from the academic faculties as well as from the industry. So that will be a clear mix of solid proposition of innovation. We are doing the academic research and we are building papers and we are doing the theses. But if you, on the other side, the industrial world or the corporate world is living in a different world. But actually, we need to merge it together. Then only the proper innovation will happen. This is a very wonderful step that Aman sir and IIF is doing. I'm really proud that I'm also a graduate from Indian Institute of Finance, and it's value added my career and my professional journey. So going into my responsibility, and basically I reviewed 3 papers, and some of the papers are already reviewed by the panelists. But even I have a common point to mention on the researchers, and these researchers are the scholars and associate professors and professors in the universities. But if it's coming into the paper, we have to be very, very clear about certain things, because the soul of the research is this population and the sample. So we are doing some innovation or in reinvention or doing a research from something that has a problem in it in the industry or the society, where we are grabbing a sample from the population and we are doing the analysis and we are coming out with some conclusion using a research method. So it's the important thing is the research design and the methodology. So what's happening is currently the people are coming out with some research and they're doing a paper research and they're making publications and adding up in the profile. Moving into that, we have to give something to the society, especially some of Madam mentioned before. We need to contribute to the literature, to the society of the research world. So each and every effort you do, we have to see in a different angle of doing contributing to the society by way of literature. In that, we have to start from the review of literature. The papers I have just gone through is, if you're really surprised, you have a five lines of review of literature in a paper. This is something not acceptable, because we have to build the research from the literature. We need to go through what does the study happened in that particular topic. Can you imagine I'm getting a paper from somebody is showing a 10-line of review of literature of a latest topic, something we need to improve on our area. As Madam mentioned before, sorry sir, we have to work on the review of literature. Review of literature is the essence, the way how you are coming. Then what are the ways you identified? What is the research gap? From that, you have to set up your research objective. Based on the research objective, you need to choose the tools. That is also from the research review of literature. What are the previous tools they have used? They use a statistical method or econometric method or primary data or secondary data. What are the tools they are used? And even what are the latest development in the industry? Because if you see, we are in a world of data science, that normally everybody is doing the research and analysis on a different platform. Everybody is behind the Pythons and all. Nobody is doing nowadays on eViews or MStat and other old softwares. They're all advanced. So we are living in an advanced world. So we need to move ourselves into the research into advanced world. So then we need to go into the deep into the analysis part. That need to be defined properly. But these all are the common comments. I have to make it before going into the individual papers. Then only you will contribute to the literature into the research community all over the world. The citation is very important thing. And your paper also need to be cited in some of the research journals later on, not only making your CV bigger. So that should be the objective. My advice to the community for the teaching as well as the research, because I'm being in the other part of this as a user, as a consumer, because you are producing and we are using, the corporate world is using the students or the geniuses. So this is the one important need. The guy studied a PhD from this university, but if you come into the analysis of the latest thing, he is completely unlinked with the practicality. So we have to improve on that side. This is a common suggestion. Don't take it another way. See, I'm moving into the first paper. This is the study of financial literacy and impact of investment behavior during lockdown period. This was by Ananta Lakshmi and Madhumati. This paper is positive contributions. Basically, this is a very nice one. It's done the purpose of the research because it's on the lockdown, because we are all facing a lot of difficulties in the lockdown period, and this is a kind of first thing after 100 years. Because before we have this flu, and now it is another one after 100 years is the COVID-19. So this is another turning point, or you can say it's even junction here. So that point of view, it is giving a contribution. But if you move into some of the improvement areas, if the title says the financial literacy and the impact on investment behavior, we have to be very clear. What is your definition on financial literacy in the paper? Because financial literacy has more dimensions. It is an educational level, or it is the person is a very expert or a medium expert and age group, and he's an earning person or he's a third person. So we have to be very clear. The definition in this particular paper, I'm giving a definition of financial literacy of this. This is very important. That is need to be improved in this area. And the sampling method. This is done in a Salem district, only 60 samples. And if you link the heading with the sample size, it is a very, very minute level connection, because you are talking about the study on financial literacy and using a 60 sample. How can I elaborate that into a macro level, and how can I come into a proper conclusion come out of it? The Six Sigma approach. All the industries will do. They will pull a sample and they say that this many machineries are come out, produced this much, this is my variance. So how can I justify by using a small sample size? That's what I said. The research core is the sampling method and sampling techniques. If population and samples should be properly linked, then only we can. We have seen nowadays some studies done by the COVID-19 vaccination by Cambridge University. They are using a proper sampling. If you wrongly do, I have done 100 sample and tested. How can I release that vaccine all over the world? Just imagine that. How dangerous it is. So that's what I'm saying. The core and soul of this research paper is this sampling. If you're wrong sampling method, wrong tools, the inference and conclusion will be. Then the review of literature. Review of literature, we have to improve a lot in the review of literature, and it is only 10 lines of review of literature. That's not at all sufficient, because the review of literature is the background of the research and what they're going to do, and it should be clearly defined on a research gap and objective. And all these standards need to be reviewed. The study has done a very structurally, but this one, they have research methods they're mentioning, and they have used a descriptive statistics tools, and they have put a proper hypothesis and come out with the result. That's all are fine. And we need to put a proper future research scope also, and how we can use it. That is the contribution to the society. Each and every paper, some of the papers I will come into that have only 5 lines of conclusion. Of the entire, the paper itself has 10 pages, but only the conclusion of the paper is only 5 lines. So that is not required. You're nothing doing to the society. So that is regarding this paper. The another one is the examining the asset pricing model in Indian stock market. This is the one already reviewed by Mr. Sharma sir. And this they are using is the CAPA model and FMA and French model. These are the multi-factor models. they've explained. That is fantastic. That is fine. They use that methodology to identify. But few things is lacking is the review of literature again. That is a common and methodology, objective, hypothesis. Hypothesis is missing. You're doing something, but it should be with a hypothesis. But I have seen in that presentation, they mentioned about the hypothesis, but in the real paper, it is missing. So it's a disconnection between the real paper and the presentation. This is the original document you need to submit to the journal. So it should conclude everything. And one more thing is the previous paper also missing. You are not putting the questionnaire. You are using a primary data as a source of your study. You have to put that questionnaire into it. And the reviewer need to go through how you are linking your each and every question to the hypothesis. So it is lacking. It's lacking the clarity on that. This is advice to everybody. And you have to put it. And even if you are using a secondary data, you are using a what package you are using. You are using an SPSS package. You have to use the version of that package. And you have to see the version of the package will give the difference in the p-value. Okay, the p-value it is calculating, and there is a fractional difference in that. And some people will use the Python or R. They need to put as a courtesy the code. What is the code they are used for that evaluating that? Is the methodology. What are the libraries they are used for that? So these are the way of transparency if you go into the details of the papers published in other journals. And this one, the Black, Jensen, and School model was used for the studies. The methodology is fine, but you need to elaborate what is Black, Jensen, and School. What is the equation? Okay, I know that it is an excess return, and you are calculating that based on the kappa model, the intercept to be equal to 0. But how you are defining in statistically, econometrically, how you are proving? What are the functions of that? What is the equation inference? What is the source behind that equation? What are the citations of that model in previous literature? So that will give a solid proof of your study. That is lacking in this paper. So apart from that, they have concluded, but they focused more on the kappa model, but Froment-French model they included in that, but there is some disconnection in the conclusion part regarding the Froment-French model. So that needs to be improved or revised in this paper. And the third one is payback policy and stock price performance in Indian corporate sector, a tribunal data approach. This is again the same thing. The review of literature side is very need to have a big improvement in that. And data analysis and hypothesis need to be very specifically mentioned. What are the hypotheses you are taken into each and every objective, and you need to mention it clearly on the conclusion and your hypothesis, how it is linked to your data and the scope of further research. And these are the common points. The structuring need to be improved, and the appendixes, you are putting the tabulations. So for my sake of suggestion is you have to mention the table, what are the related graphs and tables need to be with in the text itself rather than putting in the appendix, because the reviewer can go back again and that will give a disconnection. So better to put it in that. In appendix, the other related things like questionnaires or the other secondary data or reference data sources that you can put it accordingly using different references cited. So these are the common points I have to mention here. So I'll make a detailed report by email to Aman sir. Thank you for this opportunity. I really learned a lot from various faculties and industrialists from the experienced people. It's really nice, and thank you for inviting me. Thank you. All the best. All the best to all the presenters and the research. Thank you.
Yeah, thank you for that. And we'll go now to the last section of the conference today. Just a second. The last section of the conference today, which is the valedictory, and for the valedictory, we had actually the guest of honor, which is Ramona. I'm still trying to get in touch with her because even her colleagues, her vice rector, is not able to speak with her, and she's between places. And then we have the keynote address, which is the main address, which is to be given by Kishore. Kishore Kulkarni has already joined us, so we will directly go to him. But before we go to him, I would like to introduce briefly both of them. So in case Romina is going to join, I don't need to introduce her again. And then Kishore, before I go to Kishore for his keynote address. Ramona, as I said, is one of the youngest rectors in Romania, and she is the director of the University of Oroville, Ardin. Ard is the south of Romania, which is next to Hungary. She's been a university professor and also director of the Department of Management from 8 to 2012, and conference university doctorate from 2007 to 11. And before that, she was lecturer, secretary, and various other positions. She has had various administrative roles and academic roles, as you can see. And her area is again more management and finance. So I thought it would be nice if she comes in, but we will see if she can join in. I've been trying to get in touch with her, with most of his colleagues, and they're trying to reach her as well. But now I like to go to Kishore, who is our main speaker today. Kishore is an economic professor. He's a distinguished professor of economics and at the Metropolitan State University of Denver. He's got his PhD in economics, known him for good 20 years, and we try to structure, Kishore, all these conferences. We don't have a system of discussants or panel speakers here in India for quite some time. But we tried, having my knowledge of American Finance Association, American Economic Association, American Accounting Association, which I've attended for almost 20 years, many of the meetings. And so, I thought it's important that these concept comes in. So we rolled out in a virtual platform also. So each paper gets a referee, and we have the referee point. Even if they don't like it or like it, they should learn to listen to it. I saw in the US, you normally get about a minute or two, but here we try to give them as much time as possible to our referees. And all my referees are top-notch professors who do it. Kishore has done his PhD. He's a distinguished professor at Department of Economics at Metropolitan State University, Denver. He has been teaching at MSU Denver since 1989. Kulkarni has also taught an affiliate professor at University of Colorado in Boulder, Kobe School of International Studies at the University of Denver, Colorado State University, Colorado School of Mines. He has received numerous awards over the years, including the Distinguished Service Award in 2004, Extraordinary Service Award handed by the University President in 2010 from MUS and the Denver, and Kulkarni was recognized as the first distinguished professor in College of Business by the Dean of MAS Denver in 2017. Non-resident Indian Welfare Society of India honored him with the Pravasi Ratna Award in March 2019. The Federation of Business Disciplines recognized him on the Outstanding Educator Award recipient. He is also the co-founder of the Indian Journal of Economics and Business, which is managing since 2001 to 2016. Kulkarni has authored large number of books. We have some of them in our library as well. Kulkarni has authored, co-authored, and contributed 9 books, some of which have become very well-known textbooks adopted by American and Indian universities. The 6th edition of the Principle of Macro Monetary Economics textbook was published in 2019. Kulkarni authored the co-author of 160 refereed journal articles in Global Business Review, Indian Economic Journal, Indian Journal of Economics, and various others. Kulkarni received his doctorate in Master's of Economics from the University of Pittsburgh, Pennsylvania. He has also completed his Master's in Economics and Bachelor's in Economics from the University of Pune, now called Saurabhati Phule Pune University in India, the one which is now running the UGC CARE structure in the country today is being managed at the University of Pune, the same university library department there. Kishore has not, this is very little about Kishore. Interviewed extensively by televisions, various televisions, by CNN, CNBC, various other televisions. I've seen him coming almost every week on some television or the other on economic issues. And that's not at all mentioned here, which it should. I think his associate should help him introduce some part of that, because that shows the connect between the industry and the academics, which is important, because it's the industry which ultimately takes in the product which we produce, whether it is students or research. So it's important, and that's where his words, his wisdom, and he has been associated with various central banks, various other international government agencies as well on advisory positions, and has been a very dear friend of mine. I leave it to Kishore to give his keynote address, the very keynote address. Kishore, over and out to you.
Thank you. Thank you, Aman, for having me, and thank you for everybody for being here. Actually, and thank you for that long introduction. I know it was kind of boring for people to listen to all those things. And I do come on TV occasionally, but Aman is exaggerating. I'm there every week. If I come every week, their TV ratings will go down because I don't think they want my face to be there every week. But in any case, I think it has been a privilege to be associated with IIF for a very long time. I know Dr. Aman Agarwal and we met way back in 1999, about 25 years ago in New York. And we have been friends and we have kept in touch for such a long time. And I'm very happy and I value his friendship very much. Then we also met Yamini, Dr. Yamini Agarwal also one or two times, and she has been wonderful. So you guys have been very nice, wonderful to me. In Denver, we have about 6:30 a.m. to 7:30 a.m. now. But when I joined, it was 6:30 a.m. And so, but I'm just happy to get up so early on Saturday morning and be with you. Well, whatever I heard in last one hour is very exciting, and it's very to the point, very important. Dr. Sadar spoke and Dr. Manoj Agarwal spoke too. And whatever they have said is very acceptable, understandable, and definitely motivational for researchers. And assuming all of you are very active researchers, the life will be much better if you follow their directions a little bit in your writings. And actually, Dr. Sadar, you should be teaching statistics rather than he did fantastic points about sampling and population and conclusion and literature survey, and all those things are important. I actually
maybe at Metropolitan, maybe he can get a chance.
Was that? What did you say?
I said maybe at your university he can get a chance.
Yeah, I know, absolutely.
Yeah, because my area is econometrics basically, so I'm practicing.
No, it shows that you know what you're talking about. It's absolutely wonderful for somebody who wants to write the paper. Now, as coming to my personal life and my personal productivity, and I know that is just a message for you rather than bragging about it, because Aman has bragged about me already enough. But when I was young, and when I was young and stupid, now I'm old and stupid, but when I was young and stupid, I didn't know how to get to this research mode, because I was finishing my PhD. They were saying, well, unless you publish, you will just perish otherwise. So publish or perish was the academic message. I know when I die, I'm going to write on my stone, published but perished anyhow. So I think we will perish one day or the other, but I think publishing we can always do. And that time I was as confused as any other young man who was getting out of the graduate school and to find out how am I going to do a good job in this academic world. And after almost 42 years now, and I taught my first class in 1978, so 42 years of academic life has taught me some important lessons. Number one lesson that I learned, and then I started going to some conferences and listening to what other people are doing as far as the research is concerned. I realized that they obviously have a contribution in a paper. And as Dr. Sadar said, you have to make some contributions to the literature. Well, my main contribution, I thought, was going to be to either take somebody's theoretical model, of course, with good acknowledgement, and use that model with some different data and find out whether the different data actually sheds any different light on that model. And other people said, well, actually, you are not really doing any theoretical contribution, but you are doing some statistical contribution. You are probably testing what other people have done. And that's not a bad idea. I mean, that's what reviewers started talking about my paper, especially the referees of the journal. But then they said, oh, the econometrics is good, conclusions are good, data are good, literature survey is wonderful. So let's publish this paper. And I got excited because in first 2-3 years, I just got about 2 or 3 or 4 papers accepted by very good journals. And then I started realizing, well, maybe this is a good idea. Why don't I just take the models, and there are plenty of the models that in those days in 1980, 81, 82 time published in US journals. And I will take the model, like say demand for money model, or some kind of financial foreign exchange determination, exchange PPP, purchasing power. That is probably the easiest subject to do any research, because there is not much of a model in PPP. Well, there are a little bit theoretical explanations, but it's very easy explanation, and you can easily use the data. And I loved doing all the studies about India, but I don't know, I love that country, but I did a lot of studies about India, and then I did demand for money, purchasing power parity, and then Dutch disease, and then I started getting much interested in doing this, because the success breeds upon itself. Once you get few articles done, then you get even more excited. And in 85 to 90, almost for 5 years, I came up with another idea. I just said, well, as it is, not much happens here for 3 months in US anyway, because the classes are very small and people don't really want to be around in summer. So I just made an arrangement with National Institute of Bank Management in Pune, which is my hometown. And I said to NIBM, is it possible if I come here and do a 3-month full day research with you guys, and probably write papers? And I could impress with all that paper writing to my boss here in US. And that was the idea. Well, the director of NIBM said, of course you are welcome to come, and you can use our library. In those days, computers were not there. So he said, you can ask our secretary to type all your papers and all. So 85, 86, 87, 80, 88 summer, I even spent with Indira Gandhi Institute of Development Research in Mumbai. That was inaugurated in 1987. So I was their first visitor in that summer. And in 88, 89, all those 5-6 years, I spent every summer in India, in Pune or Mumbai, and did a lot of monetary economics research. And I said, wow, this is wonderful. And obviously, as I became, well, right in the first summer, I published about 3 or 4 papers, and they were all working papers with NIBM first, and then eventually became a journal article. And with that success, they never said no to me. Then they said, oh, you should always come back. So 86, 87, 88, 89, we did all that. And in about 5 years, I ended up publishing 25 journal articles. And that type of output obviously was very impressive for Americans, because they thought, yeah, this young man can actually work. But most of all those papers were using the models of American journals and using the data of India and running regressions. In those days. Dr. Sadar, time series was the only thing that we could do in those days. But running time series regressions and making conclusions, T statistic, F statistic was enough for impressing referees of the journal. And they got impressed, and they published, and we got a lot of publication. The point I'm trying to make here, and as I said, the point is not to brag about it. The point I'm trying to make here is that you don't really have to be extremely innovative, theoretically speaking, because bringing out a new theory is not an easy thing to do. And therefore, if you have already done a literature survey, which gives you an impressive econometric model, then you can obviously acknowledge that model and tell them that this is where I'm taking it from, and then improvise that model with some new data, that is a contribution itself. And as I said, my experience tells me that even that contribution can get you a publishable research. But as earlier speakers have said, that you have to be very meticulous in writing your paper. And as a editor of a journal for almost 25 years now, because we have our own journal called International Review of Business and Economics, IRB, and we hold conferences for that. And I know we are not as good as Journal of Finance. Journal of Finance is a wonderful journal, but we are not as good as that because I'm the only one who does most of the work for that. But in any case, with that journal, I read literally 20-25 articles every year very easily, and I read it in the form of referring them. And what I find as a common thread is that many times papers have good ideas, papers have a kind of a contribution, but it is very shabbily written and it is not organized very nicely either. So you have to get to the point where how the good papers are organized, how they are written, how there are no typing errors, how there are no English errors. And I think there are some editing agencies out there who will help you get your English corrected if that's what the problem is. In my young days, referees would comment that the paper is good, everything is nice, but we need to have a native speaker revise the English of this. And then they would say, English is not bad, but it's just that we would like different verbs for it and different expressions for certain things. And I think you want to do that. And now that after 44 years in business, my English is a little bit better. It's not a whole lot better, but still, I think I can write a little bit better now than 40 years ago. But in those days, some referees would say everything is good about the paper, but it has to be seen by a native speaker and revised. And I used to do that. I mean, I had some American friends. I can just buy them a cup of coffee and say, could you look at this paper? And they were happy to do that. So, so you will have your friends, your mentors, and as I said, there are some editing companies also. There are some good ones and there are some bad ones, but editing companies can do that. I think online nowadays there can be computer programs which will improve your English expression as well. And yeah, so I think you want to take the help of all that. And then do a good research and publish. I think publish or perish is a mantra even now in academics, and I think even now in India also they want you to publish as much as you can. Given all the new structure of our life. The whole life is changed now this year, but given our new structure of our life, I think you want to be computer assisted as much as possible, do the research at home rather than in the library. The whole library can be available on computer now, so you can. In that regard, I will suggest all of you to be a member of a free research website called researchgate.net, and the researchgate.net is a collection of roughly 5 million researchers in the world who put all their work on that researchgate.net, and the membership is free. So you should be a member of that, and I tell all my graduate students to do the same thing. And that is where your research literature survey should start, researchgate.net. Because all you have to do is just put your topic in there, and researchgate.net just pops out all the things that have happened or those who have published. Many of those authors have already put their papers in there. I have all my 170 journal articles there. That was my 2 years ago. I just hired a student who will copy all my papers and put it on my ResearchGate account. And they all are there because, yeah, I think they openly distribute whatever I write because nobody else reads it anyway. But you should put that on the ResearchGate and find out that is a starting point for doing any kind of literature survey. And I know earlier speakers have already said that you have to have a strong literature survey, you have to have a strong model, you have to have a strong data, you have to strong econometric methods, and you have to have a strong conclusion and summary as the sections of any paper. And then if you do all the things right, then even Journal of Finance will accept your paper. I almost guarantee you that, because I think that's what referees like to see in a paper. And well, very good. I know Dr. Aman told me you can brag and you can speak only for 15 minutes. So I don't want to really go overboard and not do justice to his request. So I want to stop. But if you have any specific questions, I can easily answer them. Or if you want a whole lot more to look at, just go on kulkarnibooks.com. That's my personal website, which has all the information, and also a lot of papers are there. Researchgate.net is where you should go all the time. I go there all the time. It's always there for me to help me do my research. And not that at the age of 67, I don't really do a whole lot of research, but I do have this, my principles of macro monetary economics as a 6th edition textbook, which is kind of popular popular is a relative word, but in my small world, it is a popular book. And as you can easily imagine, if it is a macro monetary economics book, it better have a chapter on COVID before the end of this year. So by this December, I'm going to add the 21st chapter to that book. Obviously, how the COVID came and what are the macroeconomic effects of COVID, not just in the US, but all over the world. Well, ironically, and do I have two more minutes?
You have 5, 10, whatever you want.
Okay.
Kishore,
Okay.
no
Okay.
problem.
Well, let me tell you a short story about 3, 4, 5 years ago. Dr. Penny Prime of Georgia State University and all, and we have been friends for a very long time and have been co-authors before too. So I was just saying to Penny, we should do a paper on what is this world headed to? And she said, well, Kishore, this forecasting is such a bad business. I don't want to do a forecast and be wrong. Because 99% of forecasters are wrong anyway, but they still call themselves expert. So I said, well, we won't do a forecasting, but that shouldn't stop us from doing a paper of what is happening, and if this trend continues, what will probably happen to the global economy. And she said, well, let's do that. And she's a director of a China center in Georgia State University. So she knows a lot about China. She even speaks Chinese and all. So she knows a lot about China. She thinks I know a lot about India. I don't know. I don't know that much. Actually, when I'm in US, I just tell people I'm an India expert. And when I'm in India, I just tell them I'm a US expert. So that way I can save my skin both ways very nicely. But yeah, so Penny thought that I will write a paper, do one India or US, of course. So we selected 4 major economies of the world, the 4 major global economies of the world, namely China, US, Germany, and Japan. And all of them are having the slowing down trend. Of course, Japan has the worst scenario last 20, 25 years. US was slowing down 3, 4 years ago too. China was having a reduction in the growth rate, and Germany was having all kinds of immigration and EU problems too. So we ended up writing a paper, and we published that. We started 4 or 5 years ago. We published it 2 years ago in Global Business Review in Delhi. And Delhi has some good publications there. Global Business Review is a good journal as well. And in 2019, we said that the new normal is not who is going to lead the future growth of the world. New normal is going to be different. And we obviously in the paper, we said that the trends look that the global economy is headed for some shrinkage. And lo and behold, and I don't want to be right for the wrong, well, I don't want to be right about a global slowdown, but we were absolutely right. I know it is unfortunate. It's not a laughing matter that COVID hit and the whole global economy. So our prediction for wrong reasons probably, but then came out to be good. And I think we were just one of those 1% or 2% of forecaster who happened to be right. And then the paper was cited very nicely. And then they said, oh, these guys were actually saying that the global slowdown is coming, and it has come. But then because of COVID, everything has changed. And I want you to spend a lot of your resources in reading in how the COVID is applicable to your field. And I don't know what your field is, but if your field is marketing, how COVID will change the marketing, how this year the management is different of companies, how you do even the HR, you know, and yeah, as far as I'm concerned, I'm more interested in macroeconomic effects of COVID, and you should look at that. That's a very Dr. Sadar will like it. That is something which corporations would love to hear you say. And actually, just last week I got a project offer to tell that investment company the future trends of economic future trends. They were going to use that to make their investment properly. It was a 6-month project, so I rejected it because I don't know whether I'm alive 6 months from now. But yeah, I just said I don't have time for that. But the offers are coming because companies do want to know what is happening in the future as far as the COVID is concerned. Uncertainty is there, but that shouldn't stop you from doing the research, and quite an applied research. I think I know somebody, I think Manoj Agarwal mentioned that if the theory is not shedding any light on the reality, it is a pretty useless theory. And I believe in that very much, because why study theoretical arguments if you are not learning anything that can be applicable to reality? So you want to do the studies which are applicable to reality. It doesn't matter what your field is, but then do all that. Again, and then you will be successful. Then you can fool the world like I have fooled the world, and I got some awards for which I would say just because they breed on. Getting awards is like a pregnancy of a woman. They breed on themselves and then just get bigger and bigger. And yeah, maybe that's not a good comparison, but in any case, I think you will be successful in your life if you apply yourself and publish and then impress your bosses and your universities and all, and everything matters in life. I'm just happy that I started very, very poor in India. And one of my friends ended up writing a book on my life in general, how I struggled in my life. So I have seen both sides of the railway track, as they say. My story has been from rags to riches, and I'm just proud of what has happened, and my family is doing very well here in the US. My both girls have done fantastic job, but that is all because of this productivity, sincerity, perseverance. Then again, being honest about your research. Yeah, don't steal anything without acknowledgement. That's pretty. That is a rubbish thing to do. In modern times, of course, referees and editors know whether you have stolen any paper. I mean, about 20 years ago, 2 professors from India actually stole my whole paper. 60% work was my paper, word to word. And 25 years ago, we didn't have computers to search for that. And one of my friends said, I remember you wrote something like this. Here is the copy of that article. And he sends me an article, and I compare that 65% word to word, my paper was duplicated there. And I was so surprised, and in a way I was ashamed for them that they did that kind of a thing. And I was very, very close to writing to their bosses and say that these guys are cheaters and liars and don't promote them or punish them. But then I said, do I really want to do all that? And I didn't do any of that. I didn't write to anybody and say this is, but the point is that, in fact, one of our professors in our university was a marketing professor. He was kicked out because he did about the same thing. And then I knew that there were some very enthusiastic young kids who were just changing the title of the paper and just presenting that in conferences with different title and all. And those things, I despise those things, and I think you should too, because they are just not giving the research a good name. So make good contributions. I think, be honest, do sincere work, and enjoy all this, because this is what it is. If you don't enjoy your profession, then why stay there? Just be somebody else, be an artist or whatever you feel good for you. So enjoy all this process. I think that's where the life is worth for, because if we don't enjoy our life, then it's a pretty miserable thing. If you don't enjoy your teaching, you shouldn't be a teacher either. So I think enjoy what you do, learn new methods, and as Dr. Sadar already mentioned, that the modern learning of the modern techniques is one of the important ingredients of your progress. So you have to learn, because just because you finish PhD doesn't mean you should stop learning. You should learn different things for different. Very good. Well, I will stop there because I know the time is up and you are tired after such a long thing. Some of you might be sleeping by now too. So I will stop and let Dr. Agarwal take over this. But thank you again for having me here. This has been a wonderful experience. And in the future, if you find an appropriate occasion, I'll be happy to come back, because Aman has been a good friend, and I will do whatever he wants me to do in the future. Thank you so much.
Sure, I always want you to do so many things. And fortunately, this virtual world has opened that option for me to connect with most of my friends across the globe and call them upon. In any case, towards the end of September, there is another event I want you to be involved. And I'm not letting you go like that consulting assignment you let go. Because in any case, I can't pay you. I can't even afford or even think about paying you. So that part is off. But in any case, I can trouble you, and I certainly will trouble you, as I do to most of my friends and colleagues. And that is there. You know, we had a keynote speaker in the beginning who gave mathematical techniques and models and all. We had another one who made the life easy and lively, giving his life history, a epic from his life history. Some very critical points he outlined are very important, which are there, which he mentioned about. And these are very key in terms of getting up things, and we need to learn from experiences like this. Before I give it to Yamini to do the vote of thanks, Ramona would not be, I just spoke to her, communicated with her while Kishore was addressing, and she is in the Mountain Hill where the internet connectivity is fairly bad today, and she's unable to connect because of rain. There is no, the Wi-Fi, they have some problem, and so she's not able to connect. In any case, I thought, I like to just give out as to what we have in hand going forward, and then I'll request Yamini to please give the vote of thanks. What we have in hand is one conference which is taking place, a 3-day conference. I have, in any case, Kishore, I will bound him in for sure. I know very well, but there are some. One of them I have a right on. I can access him, I can request him, I can force him, and that's a kind of respect. I have some rights on many people across the globe. Fortunately, I feel blessed. That is my earning, which I say. And this is a 3-day conference. It's going to multidisciplinary aspects, which are beginning to discuss. We're having about 40, almost about 40 main speakers, roughly about 30 countries getting represented at the conference as of today. And hopefully in the next few days, I'll have more who have requested to come over. In any case, if anyone wants to do this, again, a paper-based conference. Then we have one which is a monthly conference on Finance India, like which is going to be there. And then we have the one which is the last one, which is we're having in October again. on jobs, human capital, fiscal stimulus, and national labor exchange. National labor exchange is something which we have worked theoretically on for almost a decade, and we produced that work about 3 years back. In fact, about 5 countries are implementing that work. In India, the Delhi Chief Minister Arvind Kejriwal has implemented part of it called the Rozgar Exchange. And also, it has been Ministry of Labour is working on Niti Aayog, Vivek Debroi confirmed that they're working on the work to get it up. UP Chief Minister also partially introduced it, Aditya Yoginath ji introduced it by talking about the National Labour Exchange where they're trying to build up and that match up. And this is where we talk about the fact that the labor is not just labor, it's a wealth and it's a recreating wealth. And we can completely outcasting what labor theories have been talking about and giving a new dimension. And it should be treated like a share. So that wealth can be treated like a share where automatic accreditations take place. Buyer and seller, that is employer and employee, come and matchmaking of those employer-employee take place simultaneously. And this is where it is. I thought I should, and that's where we're focusing on this and other issues given the pandemic issue which is there. Now leaving this, I go to now Yamini to kindly propose the vote of thanks, and then we will end the session for today. I don't know if there's some questions, if there are any hands which they're there before I go to Yamini for the vote of thanks, if they want to ask a question or two. Otherwise, I see Manoj wanting to ask a question. Manoj, go ahead, please.
Thank you, Professor Aman. Welcome. Very nice to hear you, Professor Kulkarni. My question is actually completely from the tone of your event. If I'm looking at you, I see in your tie, you got a very excellent pattern match between the knot and the tie. Is there any mathematical model for achieving that, or is it trial and error?
There must be a mathematical model for that. But I don't know which one that is. So,
it's an achievement.
I don't know. It just happened to be the closest tie for me in the tie set. So I didn't do it on purpose. And coming from India, I know only one tie knot because I know those who can do tie knots so very nicely. They can do 3 or 4, but I know only one, and this is the only one. So it's not on purpose. It just happened as a coincidence, and I'm glad you noticed that, though.
Thank you. Thank you.
Any other questions or comments from anyone? Any of our referee addresses or any one of the participants who are still around, if they want to say something, I welcome those comments before I request Yamini to propose a vote of thanks. So I don't see any more hands up. There were a few before. So I'd like to thank, and before I'd like to thank Yamini to come in. She chipped in again back in schedule. She is the professor and director of IIM Business School, which is under AKTU, offering the MBA programs of AKTU. She is also Dean Research at the Indian Institute of Finance and has been an Associate Editor of Finance India. And since I don't want to move up the ladder, which they've been wanting me to do, so she gets stuck onto the Associate Executive Editor's position so far. Hopefully she'll get elevated to Executive Editor soon and relieve me of my responsibilities as the Executive Editor, which I've been there for almost a decade and a half now, 15 years now. I'll request Yamini, who is a thorough researcher herself, to kindly propose a vote of thanks now, and then we move on for the nice evening. Thank you.
Thank you, Aman. Good evening to everyone. I, on behalf of Indian Institute of Finance and Finance India, would like to thank each and everyone for making this conference a great success. We are extremely grateful to our chairman, Professor J.D. Agarwal, for giving his blessings as the opening address to the conference. We also feel extremely grateful for the guest of honors address by Mr. Surinder Katpalia. The institution and Finance India is also very grateful for the mathematical work which was expressed in the plenary keynote address by Professor Jackie So. We would like to thank all the research scholars, professors, as well as other participants for participating and giving their research inputs and presenting their paper at this conference, without whose contribution this particular conference would have not been a success. Their research contributions have been evaluated by different people at different levels, by different referees, both internally, externally, and by the referees. We would like to thank the referees especially Professor Dr. Paramjit Kaur, Dr. S.P. Sharma, Professor Dr. Jaspal Singh, Mr. Manoj Agarwal, Dr. Sadar Abdul Rashid for their time, effort, and valuable insights given for the research work that has been presented at the conference, making extremely rich contributions for letting the professors and the researchers work for a better contributed society with their efforts. We would also like to thank our valedictory keynote addressee, Professor Dr. Kishore Kulkarni, for his insights in his life and motivating words for all the research scholars and the professors and the different participants. Not the least, and not the last and the least, we would like to thank our audiences whose support and encouragement has continuously built upon the ability for us to continue with this effort of bringing conferences to this great platform where large scholars and great dignitaries come together and intellectuals come together and guide us into a better research world. Thank you so much.
Namaskar, and I'd like to thank personally Professor Kaur, Manoj, who has stayed back, Sadar, and Kishore, and I'll be in touch with all of you soon. Namaskar, Jai Hind, and Vande Mataram.
So much, sir. Thank you. Thank you.
Thank you so much.
Thank you very much.